Good morning, everybody. My name is Kathy Cunningham, and I'm the finance editor for the Commercial Observer. Thank you so much for joining us today for our second annual LA Financing Commercial Real Estate Forum. Throughout the years, commercial real estate experts have become increasingly adept at pivoting strategies to succeed in the industry's continuously evolving playing field. This has become even more apparent in light of COVID-19 and the coinciding market crisis. Just a month ago, we hosted our New York City Forum with no end to quarantine in sight. Now, cities across the US are beginning their phased returns to work. An interesting time for sure. We're very excited to welcome an excellent program of speakers today who will discuss how their firms have coped over the past few months and also give some projections for what a market recovery might look like. To begin with, I'd like to start by thanking our sponsors. Acor Capital, Amherst Capital Management, Hall Structured Finance, Hodges Ward Elliott, Invesco Real Estate, MAC Real Estate Credit Strategies, Madison Realty Capital, Mesa West Capital, Pacific Western Bank, Parkview Financial, Sable Capital Partners, and Starwood Property Trust. Thank you all so much. A couple of housecleaning items just before we get started. If you want to ask any questions today, please feel very free to do so. And you can do so by the Q&A function at the bottom of your screen. Also, if you want to connect directly with the panelists, you can also do this via a live poll that's going to be sent to you. So if you fill in the poll, your contact information will be sent to the panelists, and hopefully you can connect afterwards and perhaps do some business, who knows. So without further ado, I'd like to now introduce our keynote speaker, Don Peebles, Chairman and CEO of the Peebles Corporation. Should be joining momentarily. Don should be joining just a minute or two. I understand he's running just a minute or two late. And as I said before, please do feel very free to ask questions. You want this to be an interactive session. We want all of your questions to be answered by our panelists and our moderators today. Hi, Don. How are you?
How are you?
I'm very well, thank you. How about yourself?
Good, thank you.
Good. It's great to have you here today. And I understand you're coming from Florida this morning, correct?
Yes, I am.
I'm from Brooklyn, New York. So, and everything's been good with you so far this week?
Everything's been good. It's been a busy and active week.
Good to hear. So Don, obviously this is our LA Financing Forum. So I want to start with a few questions about the LA market, if I may. LA is just one of the markets that Peebles Corporation is very active in addition to Boston, DC, Philadelphia. So what is your take on the LA real estate market today and how has it evolved over the past few years?
Well, I think Los Angeles, along with the state of California, provides an exceptional quality of life. It's also a very entrepreneurial environment. It's got a wide diversity of industry. While it's very well known for the entertainment industry, it's got a very wide spectrum of industry, including finance, real estate, trade, and so on. And so it's got a consistent demand generator. But however, Los Angeles, the way it was developed on a spread out basis. And so you have this sprawl. And the biggest challenge that Los Angeles complain about every day is traffic. They have a very weak public transportation system, and they have a very large population spread out. And so people can spend, an hour in their car to go 5 miles. And so what I've seen as a trend and what our company is focused on is the urbanization of Los Angeles. And you're seeing that in downtown Los Angeles, where there is a significant urban redevelopment of Los Angeles. And so we are focused on projects in the downtown Los Angeles area as a result of that, to get people out of their cars so they can live and work in the same environment.
Right. Absolutely. And certainly, like a lot of people we speak with, developers, lenders, talk about the transformation of downtown LA. But before we get to your Angels Landing project, Don, how would you describe LA versus New York in terms of pros and cons from a real estate developer's perspective?
Well, look, they're similar markets in terms of they're the first and second largest cities in America. They're both very dense. However, New York City's population obviously is concentrated over a smaller geographic area. Los Angeles is a much larger geographic area. And both lead with very strong, dominant global industries. And so New York City is the financial epicenter of the world. But then many other industries are in New York. Los Angeles leads with entertainment as the entertainment capital of the world, but then other industries as well. However, the lifestyles are completely different. New York's a very intense, dense, concentrated, can-do kind of environment. LA is more laid back, spread out, and more relaxed. And both of them want to seek what the other has. So New Yorkers chase quality of life, generally having to go to the Hamptons or the like. And LA is chasing more urbanization and a greater level of intensity. And so they attract similar people as well. So it's not unusual to see someone move from New York to LA or vice versa, or have homes in both places.
Right.
Companies like mine will have a presence in both places.
Right. I guess the grass is always greener. You always want what you don't have in terms of your city or what it offers. But in terms of the density that you mentioned, like about New York, obviously that density has been felt in a very pronounced manner given COVID-19 and the outbreak. But in terms of the recovery, given that density, what are your projections for New York versus LA in the market recovery there?
Well, I think New York was struggling well before COVID-19. I think 2018 things started slowing down on the development front in terms of the demand for new condo inventory. Because if you look at what happened in New York City as a whole, the greatest concentration of economic activity for real estate has been multifamily, either multifamily rentals or condos. And there's been a proliferation of luxury condos. And however, as that happened, the quality of life began to diminish, as well as the tax burden, because you had SALT, which eliminated the state and local income tax deductions, and then this diminishing quality of life and the higher cost of living, higher cost of doing business, and the increased regulation. So all those things kind of combined to begin to send high net worth individuals and companies south, in many places, most often to South Florida. And so New York before COVID-19 was going to have some challenges. After COVID-19, the greatest asset New York has is its density and its efficiency of navigation and all of the activities that are available to you. That became a weakness. And then you look at Los Angeles, and Los Angeles has an exceptional quality of life. And throughout history, they have led the nation in terms of being the highest tax place in America. Yet people are willing to spend the money to be there, mainly because of quality of life. And so what Los Angeles, I think, proves, if you provide people with a good quality of life, they'll pay for it. And that was what New York's benefit was. And so I think New York now is at a point where it is going to see a more accelerated decline on the luxury residential space, and I think on the office market as well, and then other related space in the real estate side. I think Los Angeles has a hiccup because of COVID-19, but I think it'll pick its stride up. I would think that we would see, by assuming there's no new outbreak, I think by fourth quarter, early first quarter of 2021, I think we will see a bit of a rebound.
Right, absolutely. It's an interesting crisis. I think it's really accelerated a lot of trends, this crisis. I think we're seeing that here in New York. Like you said, the luxury condo sector already was under stress, but I think we're feeling extra stress on the trends that were started pre-COVID. So definitely an interesting time. Now, let's talk about your Angel Landing project in downtown LA. So this is a massive project, nearly 2 million square feet. It's due to come online 2028. Is that correct?
Yes, it is. We're really trying to beat the Olympics and be there for the Olympics for the Los Angeles host. And there, initially our plan was to build the tallest building in the Western United States.
Right.
And to do 2 towers, one a very tall tower at 450 to 500 feet, and then a 1,000-foot tower next to it, both with hospitality, both with residential, one with high-end luxury rentals, and the taller tower with luxury condos. We've shortened the taller tower to about 900 feet, still a very tall building. And we're on top of the Pershing Square subway station, so one of the few public transportation systems in Los Angeles. We're in the heart of kind of the business district, and we're on, the reason we call it Angel's Landing is on that site is a trolley called Angel's Flight. It's a historic trolley that literally just goes up a hill, and but it's a tourist attraction, and it's a part of California Plaza. So we see this as an opportunity to take downtown Los Angeles to the next level of luxury and a mixed-use lifestyle, which doesn't exist in downtown Los Angeles. So it would be similar, if you want to draw a New York City comparison, similar to AOL Time Warner Center. You know, be a very good example of that. Or, you know, if we look at an older building, Olympic Tower would be another example of that. But I mean, we see this as very similar to AOL Time Warner Center, because we're going to have a large amount of entertainment type retail space as well. And the two hotels will generate activity. And we still see a tremendous demand for hospitality in downtown Los Angeles as we rebound. We are now, of course, reacting to COVID-19, and our design team has been making adjustments to the building to address it, so that we can have our occupants, you know, safely, you know, come and go, as well as visitors into the properties.
That's great. And can you talk us through some of the adjustments that you're making in case they're helpful for other viewers, or perhaps thinking similarly about their own projects and some amendments they might have to make? Yeah,
well, I mean, we had, you know, two projects that were set for the commencement of construction this summer, and both were hospitality. Those are being, and they were, one was all hospitality in Philadelphia, and another one was in Washington with hospitality with a small element of residential. And both are lifestyle hotels that are heavily dependent on food and beverage generation. So those two projects are, you know, on hold right now. Nothing's going to happen to those projects until things stabilize. But we think Washington, D.C. and Philadelphia will ultimately recover. Washington first. The rest of the projects that we have in the Back Bay in Boston, we have a $500 million development there in the Back Bay. Charlotte, we've got a dozen buildings in what's called Uptown, which is a business district in Charlotte, on 18 acres, and that we're master developing, and Angel's Landing. And those projects are going forward, and we're taking the opportunity to make the design adjustments and some use adjustments in some instances to, you know, to address the pandemic and what could happen in the future. I mean, I think that, you know, the threat doesn't go away once we have a vaccine and treatment for COVID-19. I think that, you know, what it's showing us is that we're vulnerable. And so we're going to have to make some adjustments on how we live and how we react to future pandemics. And so we're you know, we have talented design teams. Gary Handel is doing our Boston building in downtown LA. We've got a series of talented architects, including Stantec, on our Charlotte project. So we've got talented designers that are making adjustments, you know, to the buildings now, and that's what we're using as an opportunity, and tweaking the uses to be able to be very competitive in the, you know, environment that we foresee.
Right, absolutely. Now, like you said, we don't know what's going to happen for the rest of this year with the pandemic. We might see another resurgence in the fall. We just don't really know how the rest of this year is going to shake out. But given that uncertainty, as a business owner, where are you kind of focusing your time at the moment? And how are you looking at either projects that are under development or projects that you're perhaps thinking about as future developments? How are you looking at the rest of 2020 from a development perspective?
Well, we're looking to just, we've got a big pipeline of about $4 billion of projects. And so we're looking to get those shovel ready, to tweak those. We believe that in order to restart the economies in the markets that we're doing business in, they will require significant investment in infrastructure and large-scale development. So we have large-scale development projects, and so we believe that the environment and the public support of those projects is going to be, you know, very strong. And we're looking in the marketplace to identify 1 to 2 other large-scale development projects. And then we're going to focus. We're focusing a significant amount of our energy on building out a financial services business, where we are, you know, building a fund platform that will be geared towards minority and women developers to provide them capital.
Absolutely. That's actually one of my next questions for you about this $500 million investment platform. Like you said, recently launched for emerging minority and also women developers. So it's obviously a fantastic initiative. So perhaps you can, you know, talk us through the impetus behind it, you know, when it first was in the works, how it's going so far, Just to give us a better idea of the fund and its capability.
So about a year ago, we were approached by the state of California to consider doing an emerging developers fund. I wish I had thought of it myself, but we were approached by the incoming treasurer at that time, her team, her deputy treasurer, to consider doing something like that. And we met with her and then began to do research. And one of the things I knew as a developer myself, a minority developer, I understood that access to capital was very challenging. I also, my mother started me in the real estate business, and I saw her challenges to capital and access to it. And for 36 years, every development project that we've ever developed has utilized our capital for pre-development work, aside from our first project, which we got some individual investors in. So I know that one of the biggest challenges women and minorities face when trying to compete in our industry is access to capital. And that's why you see so few women and minority developers. And so I thought it was a good idea to solve that and figure out how to scale it up. And so after doing our research, putting together a business plan and a structure, we decided to pursue a fund that would focus on the 8 markets that our company's active in and structure it more like a venture capital fund where we are investing and helping the developers build an infrastructure, utilize our platform and our relationships to help them grow their business more and more effectively and quicker. And so, and that was before any of this social protesting and these on racial disparity. And so, what the current circumstances have proven to us is that this is a serious issue that is affecting the nation and needs to be addressed. And so we hope to lead in that space to provide access to capital to talented entrepreneurs, because after all, talent is dispersed equally. It's just opportunity and economic opportunity is distributed in a very discriminatory fashion.
Right, absolutely. And I know that we're going to get on to, in a second, a very important discussion about the lack of diversity in real estate and also the lack of economic opportunity, as we've discussed. But just to stay on the platform for a second or two, so you're targeting projects of 10 to 70 million, correct?
Yes.
And the markets that People's Corporation already has boots on the ground. So if there are any women or minorities watching this who perhaps are interested in working with the fund, how do they start? How do they get involved?
They should contact our company and let us. We are doing due diligence on the sponsor level now, so that as we raise our capital, we'll be able to hit the ground running. So we're trying to get to know the sponsors and the key markets where we want to do business in. And one of the things that we are, and then if they've got projects that are time sensitive, then we're looking at those and either sending them to another fund or to one of the investors that we're speaking with, so that they can deploy the capital for them quickly, and then maybe we buy that investment from them, or at least they're getting their project going. That is the best way to go about it now.
Right, that's fantastic. And without going into specifics, can you talk about the investor base in the fund and the investors who are working with the fund to support it?
Yeah, we are it's global and national banks, public pension systems, and global investment banking. That tends to be what the investor profile is looking at. We're approaching some university endowments as well. I mean, I will say that $500 million, which is the size of this fund, is a lot of money. But we have projects that are that amount and larger, and raising this fund has been much more difficult than financing one of those projects. And so even though the risk is broadly diversified as opposed to concentrated in one project, and a market that is, everyone knows and the statistics show has been severely underserved, there's still been a challenge in raising this capital, which tells you the challenges that minority and women entrepreneurs confront. And while the industry and our capitalistic system says and promises women and minorities that this is a fair and equitable system, it really isn't. And so, we're working away raising the capital. And after as a result of these protests, we've now been re-engaged by several investors who actually said no, who now want to want to consider making investments. So I think there's a good environment for this, but that's the profile right now.
Right. That's fantastic to hear. But obviously, it's a shame that I think the recent events have kind of forced our industry as well as other industries to finally kind of look at ourselves and say we need to do better. It's a shame that recent events have kind of forced that conversation. But obviously, it's no secret that commercial real estate is an overwhelmingly white male industry. So what can we do as an industry to improve, to promote diversity, to be more inclusive? Where do we start? What's the path forward for us, do you think?
Well, I think that for the industry as a whole, I think it ought to think about survival. I remember when I first started doing business in New York in 2011, and I was on the board of governors for REBNY in 2012 for a year or two. And I remember telling the former CEO of REBNY that the business, and some of the board members, that the business model that they had was not sustainable. And what I meant by that is that New York City is a city comprised of a population of 53% female and 67% minority. And that group of people is not going to sit by idly and just never get a fair shake at opportunity. So you're not going to be able to keep this concentration of opportunity. And I told them that I thought revenue should have been a part of, they should have led on affordable housing, should have led on economic inclusion for women and minorities, and should have led the way in terms of expansion of affordable and workforce housing. And otherwise, it would all be, regulations would be imposed upon them to create that, and they would lose their power base within the state and local governments. And they kind of were dismissive of that. And if you look at where we are in local city government, it's anti-real estate industry. If you look at the legislation that's been passed by the state legislature, anti-real estate industry. And so these greater things are going to be imposed. So if the industry wants to survive and prosper, they're going to have to include New Yorkers and which or make the opportunity to be reflective of the population demographics, or there'll be a continued assault on the industry. So I think that's the case. But I think women and minorities need to work together, and they need to say that this is not acceptable anymore, that the access to capital can't go to the same people all the time. The irony is that the money being invested is in real estate, especially on the equity side, is public pension fund money or union pension fund money. And those places and those contributors to those pension systems have significant women and minority contributors and workers. And so we at least ought to get a fair shot at our own money. And I think that means that we have to be mindful of that, and we can't be afraid to challenge the system. I think the challenge also is that the system can kind of co-opt people, because if you have a job or you have a position or you're getting some opportunity, all of that is better than nothing. And you can't afford to alienate people, because then you lose opportunity. So that's one of the reasons why, I'm doing it. If I can't do it, one of the things that wealth does is it liberates you. And so I don't care. If people don't want to do a deal with me in New York City, there's 49 other states plus the District of Columbia. So I'm willing to stand up because I think I should. And I think people who are protesting now, they're risking their lives, their freedom, and their health to protest against injustices. So the least that I can do sitting here in my library in Miami is to challenge the system that I know is innately unfair.
Right, absolutely. And Don, you talked about discussions that you had almost 10 years ago with REBNY. So have you seen an improvement in the industry over the past 10 years, or have you seen things deteriorate further in your eyes prior to the protests?
I think that the industry, one, is incestuous. If you look at the multi-generational wealth and players within the real estate industry in New York, for example, it's very incestuous. I think that they are out of touch with where the country is and where New York City is. And so I think they're going to be very slow to change, and they're going to be compelled, or unless they're compelled to it, otherwise, if you left to their own device, they're going to take these baby steps. They'll do some type of internship program for a small group of people. They'll ask their workers, their members, to hire some minority workers or women, but they're not going to take the giant steps unless it's imposed on them. And I think now they've been slapped across the face a few times now, so maybe that wakes them up. I think Los Angeles has a much more positive outlook, and I think the state of California has a much more positive outlook. It's a very diverse state. It's a progressive state, and there you don't see that same incestuous types of relationships within the industry. And so the industry is constantly regenerating itself. Same thing in Miami. It regenerates itself. There's not really this legacy of, multi-generational developers or property owners that have, were born on third base, and, to be there is just to be able to walk to home plate. I mean, it's a very different environment. So I think that you'll see greater opportunity out west and south than in terms of being able to make rapid advancements. But I think New York, though, New York's in for a tough time. And I think that the public is going to demand, or it'll just continue to be these civil unrest, and business won't be able to get done.
Right. And how do you, this is I want to simplify things at all, but how do we turn, obviously there's a lot of conversations, a lot of companies putting out email statements just now in support of Black Lives Matter, but how do we basically turn these conversations and this awareness into action? What are some of the first steps that companies can take?
Well, I think it's an old tagline from the Nike ad said, just do it. I think at the end of the day, that the industry needs to, the financial services industry, the real estate industry, they need to invest with women and minorities. And they need to do that on this, imposing the same standards that they do on white men. So let's just think about what our development community looks like in New York City. You have fathers suing sons, sons suing fathers, messy divorces. You have, people who pled guilty to criminal conduct. You have people who give their properties back to lenders and so forth. And by the way, all of those descriptions I just gave you, that's the tip of the iceberg, but they all continue to get to do business. If you're a woman, or a minority, you better bat 900 to 1,000, because if you're not perfect or close to it, they're going to pick apart your track record, they're going to pick apart your career, and they're going to look for reasons not to do deals, as opposed to looking at reasons to do deals. So I think they've got to change how our industry and the people in power have to change how they see us. Also, I think there needs to be a seismic shift in terms of who is in power. I think that means from the political spectrum to the business sector. And so, but I think it's got to be decisive action. Otherwise, New York is going to become, almost unlivable if it doesn't change. Right,
absolutely. And do you see, maybe the foreseeable future, do you see the next, few years being a more equitable environment in this country?
I think that in some places, yes. I think in places where there's a progressive, aggressive leadership style, I think Los Angeles has a good shot at it, because Eric Garcetti and Gavin Newsom are younger, more progressive and aggressive, kind of take no prisoner change agents. So I think you'll see some dramatic change in places like that. I think you'll see dramatic change in Illinois and in Chicago. I think you'll see some changes. I think New York, you've got this tug of war. You've got the masses of people. And by the way, the wealth disparity is greater in New York City than it is anywhere else in the country, among the greatest disparities in the world. And so you have the smaller, shrinking group of people trying to control and hold on to their wealth, and they're not going to give it up quickly. So I think it's going to be a bit more of a tug of war, and I think it's going to take a couple of more seismic activities like these protests to bring about a real lasting change. And that will come with who the mayor of New York City is. I think you're going to see a whole different, a political environment a month ago versus today, in terms of who can become mayor of New York City, has changed dramatically.
Absolutely. And just to circle back, and before we've only got a few minutes left here, but I think one of the critical points you brought up is the access to capital. So how are you having discussions just now? And if so, are you having discussions primarily with, is it governments, businesses, or how do we improve the access to capital for minorities and women?
I think the way you create access to capital is that has to be raised to the issue. I mean, one of the things I'm concerned about right now is there's a big focus, and as an African American, obviously I'm very sensitive to this, there's a big focus on racial justice. I mean, but we've got to get women now beyond Me Too to economic justice. I mean, just like African Americans, it's not enough to say, okay, don't let the police kill Black men anymore, and let's not mass incarcerate Black men. The bar there is, that standard is low. I mean, everybody should have the right to live. So what Black Lives Matter is focusing on is Black dreams, Black aspirations, Black ambition, Black opportunity. That all matters. I think the same thing with women. Women obviously should be able to go into a workforce and be able to work and have opportunity without being harassed or attacked, based on their gender. That's a basic right. So now that we've raised that as an issue, what needs to happen is women, their ambitions matter too. Women's ambitions, their goals, their dreams, they matter. And so we've got to shift this discussion to that. And economic opportunity is deprived and blocked for African Americans and women. And so I think that collectively, if we can figure out how to join forces, then we can become more effective and more powerful to bring about a much more effective and aggressive and lasting change.
Right, absolutely. It certainly feels like a moment of awakening in this country. So I truly hope that is the case, and we move forward and we make a lot of changes going forward. Now, Don, we have a couple of minutes left. Anything else you'd like to say to the audience, or any words of wisdom you have for them before we sign off today?
Yeah, I think that we should, what I'd like to say is that, while there's a lot to be concerned about, we're at a time of great opportunity and an opportunity to be transformative. And so we have to seize this moment to take advantage of the great opportunity that has presented itself to us. While it seems chaotic, it seems, somewhat depressing and discouraging, we're really in an environment of great opportunity. And so we've got to step up and push further so that we can give more momentum to this movement of change, so that we can put, these discriminatory practices that women and minorities confront in the rearview mirror. So now's the time to accelerate, not to put the brakes on, not to coast, but to actually put your foot on the gas and accelerate. And I think if we do that and work together, we will transform our country and make it into the more perfect nation.
Sorry about that.
No worries.
Don, thank you so much for your time today. This has been so insightful and such a important time in our country, and for you to be giving your insight. And hopefully we as an industry can do so much better, as well as us as a country. So thank you so much again for all of your time today. And I think there's a few viewers already looking to connect with you today. So hopefully we can work together and keep changing.
Thank you very much. Thank you.
Thank you, Don.
Bye-bye.
I do apologize for my dog barking, everybody that is watching today. Before we move to our first panel, let's hear from our sponsors. So our first panel today is monitoring the market. Today's heaviest hitter take a temperature check as we close Q2 in the new normal, which hopefully isn't too normal. Our moderator today is Dwayne Montgomery, member real estate and business transactions at Cousin O'Connor. Then we have Ash Baragush, senior director at Hanover Real Estate Investors. Ronnie Gull, principal at Mesa West Capital. Pat Jackson, CEO of Stable Capital Partners. Tom Whitesell, Group Head of Real Estate for Pacific Western Bank, and Josh Segan, the co-founder of Madison Realty Capital. My sincere apologies again for my dog.
Good morning, everyone, and good afternoon for those in the East Coast time zone. I want to thank everyone for participating. We have a really distinguished panel here of experts, truly industry heavy hitters to discuss some of the market issues with regard to financing, and to take a temperature really of where we are with regard to financing in this current market. In this discussion today, we'll really be focusing on sort of the frame. The framing, I think, is probably the best way to say it, will be in terms of pre-COVID, the current COVID market, and post-COVID. So that's really going to color our discussion as we go through some of the issues here with regard to where we are and where we're going, particularly with regard to commercial financing. But of course, talking about commercial financing, we have to talk about the broader market and its impact on financing. So with that in mind, I thought the first question we should probably take a stab at is what types of real estate lending activities are really right now happening? We need to sort of ask that question, especially looking at it from a pre-COVID standpoint. Related to that is what's different in terms of underwriting and investment yields for financing deals versus pre-COVID. So we probably want to also touch on that as we talk about what's currently happening. And then, of course, the health of the market is so dependent on rent payments. And so who's paying rent and who's not? So I think that also should be something that we should probably touch on as we discuss what's currently happening in terms of lending. So, we'll leave it open here in terms of anybody wants to jump in and get us started on this particular segment and these particular issues that I've just raised here. Anybody want to take a stab at that?
Sure, I'll start it off if you want.
Okay, Pat, great.
Yeah, so I think pre-COVID, the market was good. It was getting very, very aggressive. Every single product type was financeable and and a lot of competition on every single deal. And then as time went on, with the COVID situation, you've seen a lot of restriction on that. And now I would say from a construction standpoint, what you're going to look at primarily is going to be mostly multifamily and industrial. Hospitality is something that I don't know if there's any lender out there really doing hospitality in the bank sector. And then office, back office is something that was being done before, is now something that's extremely difficult to get done as well. So there's definitely been a big change right now in what you can get financed on a construction side. I'll turn it over to Pat or whoever.
Okay, so before the coronavirus hit, you had a lot of options for getting your financing, whether it's a bank or it's conduit or the agencies or all the private lenders, and that's anything from a fixed rate loan with terms up to 10 years was pretty common, with a lot of bells and whistles like IO for the full term and whatnot. And recourse, non-recourse, just about anywhere, anything you wanted, you probably had a path for it. I will say that the big difference I saw, right up until then, you talk about the aggressive underwriting, it actually wasn't nearly so aggressive as what we saw coming into the global financial crisis. And, because we're such a big player in the distress world back then as well, we saw loans then that, we looked at them and said, this loan should have never, ever in your wildest dreams been originated in the first place. And some of the things that we're seeing already and some of the things that we're watching as it goes into special servicing, you can see that it was fundamentally a sound loan. It's been hit with some really bad luck. And probably the best example that we're seeing right now is hospitality, where a lot of hospitality loans that we're looking at right now are great locations, strong operators, terrific history. But unfortunately, the world changed under their feet, and it is of no fault to the operator or to the original lender that made that loan. It was fundamentally sound decision making that went into it. It's just the world changed, and so I think that's going to, as we talk later, may have an impact on what the recovery looks like and what it looks like in terms of getting back in the business. But we don't have to have a wholesale re-underwrite of or redo of the underwriting standards from like we did in 2009 and 2010.
The only thing I would add to that is that pre-COVID, obviously the markets were robust, the economy was great, and the mortgage REIT and debt fund sector just had a ton of access to leverage, right, which was driving a little bit of pricing and proceeds, and it became very commoditized in that sector. And when there was the shakeup in the capital markets, that shifted everything back to a level that it's very hard for anyone to get leverage today. And there's needs to pay down leverage from repo lenders and lines of credit. So that is driving a lot of that particular business, while insurance companies and balance sheet banks have remained very healthy. And the CMBS market, for the most part, has been shut, other than certain multifamily and industrial deals. That's a big shift. So when you look at what's available today, there's a huge part of the capital markets that just doesn't exist. And that's something that we weren't as levered in terms of how we played the market. So we've been addressing that opportunity today in the market.
Okay, Ash, what about from the borrower's perspective here? You do a lot of borrower work, so what about from the borrower's perspective?
Sure, happy to. So on the joint venture equity side, I think the biggest shift that's happened pre and post COVID has been underwriting parameters. So pre-COVID, as Tom pointed out, everything was priced to perfection. You couldn't miss on your renovation costs or your construction costs. You had to underwrite a healthy rent CAGR going forward, a low exit cap rate, and any small variable in any one of those assumptions created a drastic reduction in overall valuations at the end. Post-COVID now, we're generally looking at deals where we're underwriting little to no rent growth going forward over the next 24 to 36 months. So effectively, you mark your rents to market today, that's your exit rent several years from now. And that's a significant reduction in valuation based on a pre-COVID underwriting. And as a result, we're looking at price adjustments on the equity side from a roughly 20% plus range, depending upon specific asset classes. I happen to cover all of our multifamily joint venture investments on the West Coast, development and value add. And it's been very difficult to marry a pre-COVID basis to post-COVID underwriting without some sort of significant, again, basis reduction, whether it's through land or construction costs that you simply have not seen yet. I think from a return perspective, at least from our side, we're assuming to achieve similar returns as we did pre-COVID. The difference is, however, we look at it as a less risky investment, i.e. perhaps lower leverage at the asset side or lower rent growth assumptions going forward. As a result, a lot of the value creation is happening now as opposed to going out in the future.
I think one of the questions is whether there are willing sellers in the market to meet those underwriting adjustments, because ultimately that's what will drive deal flow as folks are able to reprice assets. It's one thing to finance an existing deal that is at a pre-COVID cost basis versus a new deal that has fresh equity on a with conviction on a new basis, which I think is an important factor. And when you look at the last cycle, it took about a year to get to that point. from kind of the depths of the market downturn, where willing sellers showed up to take those haircuts, and then buyers could come in with fresh equity, and lenders like ourselves were able to participate, knowing that there was kind of a reset basis, even if the economic fundamentals weren't as clear.
And I agree. And I think that's why, Ronnie, you're not seeing a lot of transaction volume happening now. There's just less inventory on the market from a buying perspective. I think folks in the market have the perception that if you're selling today, you're selling for a reason. There's some level of distress right now. And as a result, a lot of folks have simply pulled their investments off the market right now and are waiting for some sort of recovery to occur. And then on the recap side, to Ronnie's point, conviction, fresh capital, marrying pre-COVID to post-COVID underwriting, it's been difficult. So I think on the equity side, transaction volume has been low. A lot of folks have money in dry powder, as do debt funds and lenders alike. It's just transacting in a post-COVID world has yet to hit.
The problem has been really, and the reason why there's very little volume out there of sellers, part of it is because there's a lot of hidden distress out there, which is, the borrowers are working, or lenders are working with borrowers. They're giving them 90 days, 120 days, 180 days. And obviously in office, retail, hospitality, there's been the most extreme kind of workout conversations happening behind the scenes. Now, if that changes the slightest bit, that could lead to some of the pressure we're all talking about. And the landlord-tenant problem is a problem that hasn't been addressed at all from the federal government, from the Treasury side of it, and it's more state by state. So if that dynamic doesn't get worked out and fixed, that can lead to more of, while the banks, we said, were very healthy and it's not a problem as compared to last market, that can change dramatically if that problem continues to exist. And that will lead to more pressure that again, it's not visible, but there's plenty of this pressure going on behind the scenes.
Yeah, I agree with that. I think we're kind of in a lull right now. And when COVID hit, really when everyone started getting excited about it was like middle of March, and then we all jumped on it and looked at primarily the biggest issue obviously was hospitality. That got hit the worst, right? So everyone started working with them, and the standard kind of deal was usually a 90-day forbearance transaction type deal, just kind of kick the can down the road a little bit, basically tell your borrower, hey, here, we're going to give you some relief. We're in this together. We understand what's going on. And so we'll give you this relief here, but in 90 days, please have your rescue capital ready, and maybe the world's better by then, and try to get your hands around the portfolio. The reality is that, okay, after that 90 days come, September, where are we going to be? And also during that time, you're seeing the CMBS market where the special services really don't have the ability to do much. And so when that happens, there's going to be a crater in that business. So you're going to see a lot of deed in lieu or just straight foreclosures, I would think, in the CMBS market, which will have an overall effect on the rest of the valuations and just the hotel market overall. So I think this fall is going to be very interesting to see how that plays out. I mean, you got to juxtapose that with the fact that some of these hotels are opening up and doing fairly well in some drive-to markets and all that. But is that sustainable? Is that sustainable for the whole year? Maybe it's good for the summer, but we'll see.
So in terms of talking about the market here, are we sort of saying that it's pretty good as it relates to industrial, office, but you're talking, and multifamily, but you're talking about problems as it relates to hospitality and retail. Is that your perspective, gentlemen?
I wouldn't put. Go ahead, sorry.
No, go ahead, Ron.
We're probably going to say the same thing. I wouldn't put office in that category. I think.
Right. Yeah.
I think if you look to Tom's earlier, comment, the liquidity is in industrial and apartments, and apartments in particular is with agency loans. And so if an apartment deal fits the agency bucket, there's a lot of liquidity. And in fact, we've seen examples where if you can fit, let's say Freddie's affordability bucket, there's an arbitrage there in terms of where you can finance your deal versus taking it to, just a straight, agency loan or even outside the agency world. So you kind of isolate apartments. I think that the ones where the collections are still strong and there's agency financing, there's liquidity there. Industrial is liquidity. I think office is challenging because I don't know anyone can answer the question of, what rents look like in certain markets and what the demand looks like. And you can make all kinds of hypotheses about whether work from home impacts things or doesn't impact things, but no one really knows. And until people know, it's hard to really underwrite deals effectively without someone coming in and repricing an asset to a level that you could have some conviction purely based on the strength of sponsorship and the quality of the asset over a longer period of time.
Okay. What special types of provisions are showing up in some of the financing documents as a result of COVID? For example, are there COVID reserves being drafted into the documents these days? Anything related to rate lock or spread lock provisions? What are we seeing when, let's say that you're ready to go forward with some financing? What can you expect some of the lenders to throw at you?
I'll start. Certainly for fixed rate product, which is for our conduit, we've added language that everything's really subject to what is the market. It's almost like a MAC clause that is pretty broad. I don't know how you can, and by the way, the big challenge we have, anyone who's using securitization as your exit, is the unknown about volatility in the credit markets. And, it's been pretty darn stable lately, which would imply you could price it pretty accurately and figure out what you're going to make on it, assuming everything holds true. But, there's, from the time you issue your initial application through the underwriting process, who knows what's going to be there. So you have to really put things in your documentation to protect yourself. And then additional types of protections around debt coverage reserves and whatnot that we just didn't see before all this occurred. And the initial feeling from borrowers when we first started talking about this, and we were Freddie and Fannie lender as well, about putting this debt reserve, so oh my gosh, that's unreasonable. But I think people have kind of gotten over it, at least the borrowers we're dealing with, because we make the point, it's your money. Why would you not want to put this in place to protect your equity? And I think that we've seen over the last, let's say 2 months, since beginning of April, when this really went into full effect, a lot of borrowers have kind of gotten around this now and gotten over this and realized that you're right. It's the prudent thing to do for the lender, but it's also the prudent thing to do as the investor. And to the degree that everything normalizes and we can get through these uncertainties behind us, the reserves will get released. But the documentation around the loan that's being ultimately originated has all that now in there that we didn't have before. And I think education has gone a long way, basically saying, look, it's your money. We're not trying to hold on it forever. We just need to be smart, because we're very quick to tell people that as a lender, we only have expected news and bad news. I mean, if the market goes roaring and you have a great outcome, we're just going to be lucky. We just get paid back at par and nothing more. So understand that our risk tolerance and your risk tolerance as an investor are different, and we have to be lined up so that we're protected as well. And that seems like that's been the biggest change I've seen, and the documents have to reflect that.
I would say on the portfolio side, so we're a portfolio lender, okay? And most of the stuff that we do now is construction, and it has been over time. We'll still do some value-add bridge deals, but I think really the difference for us and for a lot of portfolio lenders is more of an attitude change rather than more documentation. And that is, I believe that, it was completely a borrower's market in February. Pricing had gotten very aggressive, terms had gotten aggressive across the board. Now it's a different deal. Lenders, it's now become a lender's market. And then most lenders are viewing this like, if you want, there's scarcer number of lenders, or there's fewer number of lenders able to do the deal and able to do and willing to do the deal. And so if I'm willing to do a transaction with you, one, I want to get paid for the risk.
Yeah.
And two, I want the loan on the book a little bit longer. So I'm going to have more of a yield maintenance in the deal or minimum interest in my transaction. Because as soon as this property, you go through we take the risk now and go through the business plan with you and get you to the finish line, you're going to want to go refinance this. And rightfully so. That's what you should do, right? Just because there's going to be cheaper money out there. But we want to get paid for that risk a little bit. So we're going to ask to try to keep in the deal a little bit longer, or just increase the minimum interest. And we're seeing that kind of across the board right now. And if you think about a lot of portfolio lenders that do construction, you've had, like last year, you had so many loans get paid off, at C of O. You had an apartment project completed in C of O, it's getting taken out and money's been put back into the borrower's pocket. Today, that's not happening. You're seeing people, when we have deals come up at C of O, they aren't getting paid off, or they're very, very slow to get paid off. It's going to take a while, and they aren't getting the number that they want. So what we're seeing as a lender is that your portfolio is growing. Half of our book is a commitment, and the other half is outstanding. And so we're growing our book anyway with it, because there's no payoffs. The payoffs is down dramatically. So when you put that together, most lenders, portfolio lenders, don't have to put money out. There isn't this inherent pressure. So they're going to be very, very smart about what they do, and they're going to pick their terms that they're willing to transact at, which is completely different, I think, from February, where there was a huge pressure to put the money out because you had the fear of being paid off and you were on the cycle.
Is that the same view from the rest of the panelists as it relates to construction lending? What's your position in terms of how your construction or bridge loans have held up in this COVID environment?
I mean, I have one thing to add to the difference in sort of terms. Pre-COVID, I would say there was a lot of like pari passu funding amongst a senior and mezz lender or an AB lender. That was a change that really happened, post financial crisis. That sort of pari funding never existed for a long time, and that changed about 3-4 years ago as there were added lenders and added pressure in terms of both pricing and proceeds and terms. And that's a big change that has shifted amongst a number of the non-recourse kind of construction lenders or bank construction lenders, which really has an impact on end pricing to a borrower, and therefore cost of capital, and probably therefore valuation of land, what a developer can pay for a property. So there's significantly more cost if a B note lender or mezz lender has to fund first, and then the bank funds last. So that pricing wise, that's a big change. But that has been offset for those that can actually build through this right now. It's a great opportunity because construction costs are down between 12 and 15% if you can lock in contracts right now. And that's a huge savings. So there are a number of developers that are very far along and will pay up in pricing for those that will lend, just given the fact that, if you can build through this, there are a number of savings, and not to mention a lack of new product coming available in the next 2 to 2.5 years. So we don't know where rents are going to be, but we do know there's going to be a lot less supply over the next 2 to 2.5 years.
Let's follow up on Josh's comment about opportunities. What are you seeing in terms of, what would you see as opportunities out there to look for as hopefully COVID, we get to move more into the post-COVID era here? And let's talk about that a little bit from each of your perspectives.
I guess I can start. So at Sabal, we have two sides of our business. We have the investment management business where we bought and managed thousands of assets in the last cycle. We started lending. Now that's a big business, both agency, conduit, and bridge, which continues. And we buy the B pieces. We're one of the largest B buyers for agency product and for the conduit. One kind of was roaring along when the other one was dormant. And we're going to be in an interesting time because while our lending business continues to do well, frankly, particularly because of the agency liquidity, as Ron mentioned a minute ago, we think there's going to be a lot of distress coming. And we're already seeing a lot of deals being brought to us. We've actually already bought some things. And we think that over the next, let's say, 6 to 12 months, there's going to be a lot more to one point, because, what Josh said, the grace period is going to burn off. The chance to kind of kick the can down the line is going to be over. And we're already seeing, the security, opportunity kind of came and went quickly because of just people getting it off their balance sheet to raise liquidity for margin calls. But now we're starting to see pools of loans, and they're big pools. I mean, $300-500 million pools of loans, and we think this is just the leading edge of what's going to happen. And it looks and feels an awful lot like how the trickle became a flood in 2009 and then 10, and then we were seeing several hundred million a week at some point back in the real go-go days of the global financial crisis. And there's nothing to assume that we're not going to see a lot of that more coming. If for no other reason, if you compare the amount of debt that was outstanding on real estate today versus the amount of debt that was outstanding, at, let's say, in 2009, is 2x. And even if default rates and ultimate distress is equal from a percentage point of view to what it was in 2009, it's going to be, a huge number in play. And we feel like we're extremely uniquely positioned, just given our long history in commercial real estate as an investor buying pools. And you don't want to wish for bad news, but when it comes, we're going to be ready and we're going to take advantage of it. And I think that that uniqueness of our business model is going to basically, win when things are bad and win when things are good. And that's what we've set ourselves up for. And we'll see what happens. I guess we can wish for the best and prepare for the worst. It's probably the mantra that we're following.
Pat, are you seeing a bifurcation? Sorry, Tom, go ahead.
No, you go, Ash.
I'm just going to ask Pat a question. Are you seeing a bifurcation in the loan pools, i.e. a hospitality pool because someone has a lot of issues, as opposed to a multifamily pool where they're just trying to raise liquidity and trade close to par?
I'll say, yeah, well, yes. Let's just kind of answer it that way first. But we see hospitality only pools. You've probably seen some stuff like that as well, where different groups are just saying, let's just get rid of all of our hospitality because it's not, no one sees it getting better anytime soon, and it is so distressed. It is under such siege that take your lumps and move on. And then we're seeing mixed bags of pools that are being billed as I'll call it dislocated rather than distressed, because nobody wants to use that word. I guess they're looking for less of a discount. And it'll be a mixed bag of virtually every type of asset class. But if they have hospitality, if they have retail, you can bet you that's in there. The three asset classes that we're most focused on as far as what's coming is going to be hospitality, retail, and office. I would put office in that bucket because the big unknown. And then the reality is, multifamily had a blip, but it's already recovered. If we look at, what the rent collections were in May versus what they were in April nationally, it's already back in the 90s. So the question about that is that stimulus driven, or people basically saying, I'm going to pay my rent. We don't know. But we're bullish on multifamily long term, regardless, because we think the supply demand, especially in workforce housing, is so out of whack that it'll find its watermark pretty quickly, regardless of whether it's stimulus driven or not. And then industrial and warehouse and self storage seems like it's clicking along pretty well. We aren't seeing any real distress there. But every property, as we're in this business, every property has its unique issues that may create a problem at a property level. A warehouse that may have a big portion of its tenant base affected by coronavirus is going to be affected by just a general purpose warehouse. So who knows? So we're seeing it all, but we're definitely seeing it most concentrated right now in the asset classes that I think everyone's worried about, and that's hospitality, retail, and office. So long answer. That's right.
Yeah, I would also just add to that there's a lot of big differences between today versus what we were buying and performing and non-performing post the financial crisis. A couple of things is just like who you're buying from. At that time, it was primarily banks.
Correct.
And it was banks that were teetering. Some were banks taken over by the FDIC. They had nominal rates at the time of like 5, 6, 7%, with the rates typically 5 over the note rate of 10 to 12%. If you look at the product being sold today, a lot of it is coming from alternative lenders. So there's been such a growth in the industry over the last, you're talking 10 years, that industry has just grown so much.
You're right.
The end, what was going into the system at the end was very, very low rate stuff with very, very low default rates. So average rates of LIBOR 300 with a nominal rate today of like 8% at a high LTV and office, retail, hospitality. The problem is if you have to sell that loan today, you can make loans today at much better rates and much lower LTVs. So naturally there has to be a real discount if someone has to sell. And those that have to sell have typically come from mortgage REITs, debt funds, people that were in liquidity sort of crisis mode. And some of that was from loans that didn't even get into a CLO. So there was probably $3 to $6 billion of product that was backed up in the system that never got off the warehouse line to the CLO. And that's backing up the alternative lending market as well. So that's a major shift. But so the product type and the situation is very, very different. There are many similarities. And again, like what is not a banking crisis today can become that if again, regulators start to drill down on the community banks. That the Fed and the Treasury dealt more with the larger banks for the most part. That's who they typically deal with. But you have so many banks out there, small, medium, regional, that are more real estate based and are going to deal with the landlord-tenant problem differently. And again, that will become more relevant as some of those banks hit some real snags in the next 6 months.
I think our expectation in terms of business kind of post-COVID versus pre-COVID, in our world, we're financing core plus all the way up to value add deals in primary markets and strong secondary markets with good sponsors at kind of moderate leverage. I think our focus will be the same. It'll similar to the last cycle. You're going to see a repricing of assets, and there will be some distress, and that'll result in quality assets being traded. And I think our view is that we'll be active in that space and have capital to deploy. The fundamentals won't change. I think we're still going to focus on good sponsors and good real estate and good markets. I think that's probably true for all of us. I think what will change is that we will have our focus on structure, which we held on to kind of even at the end of this pre-COVID environment. I think we'll have even greater ability on structure. I think that will be a positive. And then on economics, it'll just depend on where liquidity shakes out in the market, because at the end of the day, people are running businesses on a levered loan, model, and there needs to be an active bank market in order to kind of facilitate the flow of credit to the broader real estate lenders in the industry.
Okay.
I'll just add one last thing, Dwayne. At the end of the day, like everyone else mentioned, I think on the equity side, it is an opportunity for flight to quality. Whereas folks were stretching out to secondary and tertiary markets for equity yields. If in fact you do see the distress start to come to play the latter part of this year, perhaps into next year, there's an opportunity to retrench themselves into more core markets whether it's East or West Coast, into perhaps even more core asset classes. Whereas, we may be looking for Class C value add pre-COVID. I may be looking for better located Class B plus, where the value add lift is not as heavy as necessary, where the tenant profile or demographics or income levels, et cetera, are stronger to support, higher rent growth going forward.
Yeah, to Ash's point, deals were priced, there was very little differentiation between a truly Class A deal and then a B deal in terms of pricing in some of these, tier one markets. And so you see buildings that traded for pretty big numbers that I think will disproportionately suffer as assets reprice.
Yeah.
Okay. So let's step back for a second and look at this from a historical standpoint. Are we seeing any historical changes starting, or is the verdict still out on that in terms of whether we're in a historic period with regard to the industry? I know it's kind of difficult to tell when we're in the midst of it here, but is what we're experiencing, do you think, going to be historic, or is this just a blip, and once COVID is put to rest, which may be a while, we'll get back to business as usual, and there really won't be many changes to speak of with regard to the industry? Any thoughts on that from a big picture standpoint, historic standpoint?
I'll address that because I get asked that question a lot by our investors. And one of the stats I saw that I just think that you can't ignore, and that is the number of people who had never experienced online shopping. And I think the stat came from Amazon that 40% of their new orders, 40% of their orders during COVID have come from brand new customers that have never done had an online shopping experience. And I think people are now becoming comfortable with that. And when you look at making real estate decisions around real estate, part of the things that you have to think about is, what is going to be the ongoing retail buying patterns that you can depend on, and that's fundamentally shifted. I mean, I know just using our household, we were already online shoppers, but we've gone almost exclusively to an online shopping mall for everything, and that cannot be. If you're in retail of any kind, you cannot ignore that is going to be a shift because of the convenience factor that people have now discovered, and it's a massive number. I mean, I was going to make Jeff Bezos the first trillionaire, maybe. But the really, the reality is it's going to change a lot of things, and that's probably from a big macro trend. One of the things that I see, we've kind of touched on office. I think that there will be a change as to how people use offices, but I think there's generally a natural tendency to want to congregate and be with people that you work with. I think the question about the efficiency is less of a question now because people have proven that we can get things done, via Zoom. And we've been decentralized for a long time, but we look at our office locations. We have a big office in New York, we have a big office in Kansas City, and then two big offices here. We've made the decision that we're going to not renew the lease for our Kansas City office, which has, I think, 14 employees, just because when we talk with those employees and ask how they've operated, they're all saying, you know what, I haven't missed a beat, and frankly, it's not necessary. So we're just one little microcosm of the world thinking, and we're deciding that we can do it differently. And so I think that there's a lot of changes that'll come that we don't yet know what they are, but a couple of big ones that I'm already seeing that you just can't ignore, and it has to do with office and retail.
Okay, so besides office and retail, any other thoughts in terms of what we're seeing that might be historic or could be, depending on how things shake out?
Yeah, I think, really more from a social standpoint, with the George Floyd killing by the police and all that has become, and the protest, it's gone 15 days straight. I think that's real. It's not something that's a flash in the pan. And, I kind of think about our industry, and our industry is dominated by white males. The white male privilege is unbelievable here in our business. And so I think, the difference, I think that there's going to be, an impact across, hopefully across all businesses, but hopefully in our industry that will start, really focusing in on hiring more minorities and, not just, saying we're going to do that and women, but actually doing it and setting, guidelines for ourselves and saying, okay, because you can't change it just by saying, oh, we're going to do these things and put some governmental programs. All those things are, some are going to work, some aren't, some are going to have the opposite effect. Take rent control, for example, ends up, doing the opposite. It gives you the opposite impact half the time. I think it's really got to have to start with us in our industry, hiring people, letting people inside, having people at the table, and elevating those people. So that's the way you're going to change this thing. And I think it is historic. I think it is going to be something that's going to be very positive if we all are committed to do it, and it continues. And I actually hope the protests continue for, peaceful protests continue for a long time until there's some real legislative changes and also changes by, industries. You saw the NFL step up and finally, say something correct. I don't know if it's just, something they just said, to kind of get on board, or if it's something they really believe. So we'll see if that seat opens up and if people are allowed to kneel without criticism.
Okay, thanks, Tom, for those further insights. Any other on the panel? Any others on the panel want to add to this? Because I think what we'll probably want to do is go to some questions, if we have any from the audience, after we address this. Any others of you want to address the historic nature of what we're going through here and how it's affecting the industry?
I can just add quickly on the multi side, what we've started to see in some of our properties is tenants actually leaving the urban infill markets and wanting to go out to more suburban areas where there's more open space, more backyards, it's less dense, et cetera. So this whole transformation to the TOC or TOD corridors, where you can ride public transit or trains, et cetera, I think in the short term, that's going to have a bit of a pause, similar to, for example, a co-living. But I do think long-term, as it relates to perhaps herd immunity or some sort of vaccine, there's a reversion to the mean. And I think folks do ultimately come back to these infill sites. They get more comfortable being in the public arenas. So I think it's a short-term phenomenon, but at least on the multi-sector, I think long-term things will be fine.
I agree.
Okay. All right. Let's see. I think we have some questions here. So I'm going to start them. Let's see. First question, how are you all making sense of how the stock market is reacting versus what you're seeing in your business? So that's the first question. Anybody want to tackle that one?
That's a Ronnie Gall question.
All right.
Okay, Ronnie. Turn your TV off. It's, look, the equity markets, are often leading indicators, but they're also, to some degree detached from what we may be seeing in our own, smaller worlds of real estate, right? So I'm kind of baffled by it, but at the same time, there's a ton of liquidity that the Fed's pumping into the system. The Fed's made it clear that they're going to support the economy in every way they can. I think the interesting thing between then and now, if you go back to the GFC to now, just to frame the answer to this question, you had 18 months of buildup between the first cracks in the Bear Stearns credit, in the credit hedge funds in the summer of 07 until Lehman collapsed in September of 08, right, roughly. And then the policy response took several months after that with fits and starts. And in this crisis, you had, in a matter of weeks, it's almost like an earthquake happened, but we don't know where the fallout is. But the federal response and the Fed response has been enormous and is more far-reaching than anything we've had in the past crisis. So I think the equity markets to some degree are responding to, the Fed put, if you want to call it. They're not going to allow the markets to fall too far. But at the end of the day, reality catches up. And I think the jobs report that came out last month was a shock to the positive. But if you dig deep into that report, there's some negatives in there that are pretty alarming. And as you go forward, it's hard to say. So I try to not focus on the market and focus on the fundamentals in our business and look at where we're at and look at, we look at collections every month. We have our asset managers line up collections on every asset. We're watching those trends month to month. We're seeing, how that evolves. And I think that's being more micro in this environment and focusing on the fundamentals and the details, I think, is kind of a better guidepost than looking at the equity markets now.
Yeah, I would agree.
Okay. We've got some more questions here, so I'm going to go ahead and throw them out. When do you anticipate value add transactional liquidity coming back and spreads coming in? What needs to happen? Make a prediction. All right, so they want to box you in on this. So who's game for this one?
Ash is the borrower here, so Ash should be.
I actually think on the equity side, there is value add transitional liquidity in the market right now, period. There are a number of funds out there who, like us, are actively looking for an investment opportunity. It's just the bid-ask spread, again, on post-COVID underwriting seems to be too far off. And the numbers don't make sense at this moment in time, which is why I think across the board, you're seeing lower transaction volume. Perhaps on the equity side, maybe the loan buying side is a bit different. So if I was to predict, it really depends on when we get sellers to capitulate to what I think is the new world order from an underwriting perspective, and maybe that's later on this year or next year. But I think capital is there, and I think, I'm a borrower of Ronnie and Tom's right now. I think if I came to them with a good deal right now, they would finance it as well. So I believe liquidity is there. It's just really a function of finding the right investment opportunity.
Agreed.
Yeah, I agree. I think that liquidity is there for it, just pricing. The price is not going to come in for a while, and I don't think anything really comes in, and we don't get stabilized until we, somehow resolve the COVID-19 situation, either vaccine or some drugs that actually mitigate or cure you from it quickly. And until that, and people feel comfortable, again, just everything evolves around all the other parts of the business of travel and meeting people and going to hotels, restaurants, and all that. You aren't going to feel comfortable until that happens, and then that will feed everything else to make the economy stronger and better. But until we get to that point, I think it's anyone's bet on how it is. And if we have a second wave, which it's very likely, it looks like we're having it already, it's just going to make it worse. I don't see our country shutting down, but I do see at all. I don't think the country will allow us to shut down again. But I do think that people are just going to say, "Oh God, I'm not going to go to the restaurant anymore," or I'm definitely not going to travel. I'm not going to get on a plane. So it's going to hurt and delay the recovery from that.
Okay, I want to thank the panelists here. I think we've used up our time. Ash Baragoush, Ronnie Gull, Thomas Witzel, Josh, and also Pat Jackson. Appreciate you being on, and that finishes this segment of the forum. Thank you very much.
Thank you, Dwayne.
Thank you. Stay safe.
Thanks a lot, guys.
All right.
Yo.
Nice. Wait a
Thank you so much, Dwayne, and the rest of our panelists for a great panel and great insights there. Our next panel is entitled "The Shoe Has Dropped: Finding Opportunistic Strategies for Yield in a Volatile Market." This panel is moderated by Bill Fischel, Senior Managing Director at JLL. We also have Brett Katz, Managing Director and Head of West Coast Operations at Hodges Ward Elliott, Robin Potts, Co-Head of Real Estate Investments at Canyon Partners Real Estate, Paul Ramian, CEO of Parkview Financial, and Vicki Schiff, co-founder of Mosaic Real Estate Capital. Welcome, everybody. And Bill, I'll turn over to you.
All right. Hey, everyone. How are you? I'm looking at everyone's profile pictures, and then all of us here. I think I need to shave when this is all done, but I'll wait another few weeks. So I want to go around the horn and let my panelists introduce themselves. My name is Michelle. I run the debt structured finance side of the business for JLL in Los Angeles. Robin, if you want to start, we'll just go Vicki, Brett, Paul, and get into our discussion.
Great. My name is Robin Potts. I'm the co-head of real estate of Canyon Partners. We're an investment management firm headquartered here in Los Angeles. We have about 25 billion of assets under management across a variety of strategies. Within real estate, we're focused on both debt and equity investments, so up and down the capital stack, all property types, with a focus on value add and opportunistic.
I'll go next. Hi, Brett Katz, head of West Coast Capital Markets and part of the national team on capital markets for Hodges Ward Elliott. We're a premier boutique real estate advisory firm. We focus on all the food groups with a specialty in hospitality, a private company, been doing advisory for over 45 years. Capital markets business specifically, we began in 2016. And have since done over $10 billion in transactions across all the food groups and are very active right now in the post-COVID environment on the advisory loan side, as well as loan sale, advisory, and asset sale side.
Hi, I'm Vicki Schiff, and can you hear me?
Yes.
Okay, great. I'm Vicki Schiff. I'm the managing partner and co-founder of Mosaic Real Estate Credit, a firm that was founded by myself and Ethan Penner in 2015. We've originated around $2.5 billion of debt in that time through our New York and LA offices. And we kind of play up the capital stack on the debt side, first mortgages, mezz, and some pref equity with some LTV limitations. And we've looked at a lot of deals in the post-COVID environment. We're very bullish on certain asset classes, and we're in the market. So happy to join such a great group of people.
Hi, everyone. Paul Rahimian, Parkview Financial. I'm a third generation real estate developer and general contractor. At Parkview, we specialize in ground up construction financing throughout the United States.
Very good. Well, title. So the shoe has dropped. We are now in kind of the day after tomorrow. And unfortunately, I don't think anyone has told public equities investors. I know we had a down day this morning, but it certainly feels like asset pricing is moving pretty dynamically. It is market. And it's a comment I know a number of us have amended from saying that the last, few months have been as volatile as they've been in the last 11 years. My personal perspective is it's probably as volatile as it's ever been. Because for those of us who were active in 2009, you remember 2009, 2010, there just wasn't a whole lot happening, right? Today feels a little bit different from that. And so, Vicki, we'll start with you. Where are you guys finding opportunities today? Where is there, lack of liquidity? Where can you kind of deploy your capital and find really interesting opportunity?
Sure. We're obviously being extraordinarily cautious. Values, who knows, right? I mean, has anybody gotten an appraisal lately? It's kind of interesting. We have primarily been construction lenders really from the beginning because we try to seek sort of more underserved markets. And, I think Paul's in the same business as we are. about 70% of our book is in construction, and most of our assets won't be open for 2 years plus. We're looking at, and we're national, so we're looking at assets underserved. We like multifamily, we like industrial, no secret there. And just looking for markets that have undersupply, and we are getting a lot of requests. So that's really where we're focused on today. In addition to borrowers that may be undercapitalized, they may have given up staying power, but they're really good at what they do. They have integrity and they have good assets, and we're looking at capitalizing those types of borrowers as well.
No, I think you nailed it with the counterparty side, right? Of it's
Yeah.
great today if you can make a bet on something that's going to echo 2-3 years from now. Knock on wood, I don't know what we're going to be talking about in 2022, but I certainly hope it's not COVID. Being able to go make that type of investment in somebody that, again, predicated on their ability to finish a project feels pretty good. Paul, you're pretty active in that space. And so how has pricing moved? How's leverage changed? When you think about some of the deals you were doing pre-COVID versus today, what's profile of a typical deal for you all?
Yeah, great question. I was thinking about it this morning about our panel. And, the way I look at it is that whatever you believed in February of 2020 and whatever pricing was, whatever leverage point was, whether it was a seller's market or a lender's market or a borrower's market, we all know in April of 2020, everything was an exact flip. We basically pushed a reset button and everything changed. And what happened is all of us lenders were out there trying to get deals, trying to put money to work. We were doing whatever we could to put money to work, and pricing was coming down. Everything was being compressed and everything literally flipped. And now we saw overnight pricing being escalated. So what we're seeing now that we're 90 days into it, is a pricing bump of about 200 to 300 basis points above what the pricing was in February pre-COVID. Almost what I've been saying to people is we're really back to pricing of where we were in 2013, 2014, right when we were coming out of the 08 recession, and pricing has actually got back to that level, which is surprising because 3 months ago, we were all chasing the pricing as low as we could just to put the money out.
Now, if Brett or I call you, we get a discount, right? We're on the lower end of those ranges. That's my understanding. That's right.
Oh, for you guys, it's free money.
We appreciate that. That's very kind. So Robin, you've been active through multiple cycles. Again, when you all think about the bets that you're making today, is there anything structurally different? Are there different types of development opportunities or even bridge loans that you're seeing now that, to Paul's point, in a more competitive environment, literally 3 months ago, weren't pricing in a strata that was interesting?
Right, I think the opportunities that if you're willing and able to devote time to putting capital out today has expanded pretty significantly. And I say willing and able because, immediately following COVID, across the lender universe, there's been a lot of challenges with liquidity because a lot of lenders in the debt fund and mortgage REIT space are structured as levered lenders that are reliant on warehouse facilities or repo facilities to make a new loan at an attractive price point. And those repo and warehouse lenders have been applying a fair amount of pressure in terms of being deleveraged on their existing portfolio, and then in many cases not willing to advance for new loans for those lenders. So I would say the lender universe at this point is contracted. Obviously, the CMBS and CLO markets for real estate shut down for a meaningful period of time, and they're now working to reopen a bit. But across the board, liquidity has been constrained. So from an opportunity set perspective, we're seeing a much wider set of opportunities that's interesting on the debt side. So being, a provider of liquidity from a bridge or recap perspective, where previously, there would have been, 20 quotes at LIBOR 200 or 300, that doesn't exist today. And then on the construction side, because of the pullback, essentially, we think there's interesting situations at lower leverage with really strong sponsors. And then there's also, an opportunity set that hasn't been around for a decade, essentially, with a lot of note sales coming to market from lenders who are looking to generate liquidity, in most cases to reset their warehouse facilities and pay those down in some respect. So a lot of activity on the debt side. On the equity side, that seems to be taking longer to open up because there's a bid-ask spread in the market across most asset classes. So I think, that'll start to open up a bit in the second half of the year as the economy reopens and people can really get a handle on if they need to transact, because most people have just been not transacting if that's possible for them.
Right. No, I think it's an astute point, and that's where you've seen a number of those deals that were slated for disposition sliding over to financing. Right, the activity we've seen today has very much been in the credit space. Brett, we sit in a very similar position. That nexus of capital and opportunities, working on behalf of our clients to kind of find the best deal. Where is the opportunity? What kind of is keeping you busy right now when you think about post-COVID versus pre-COVID? How's your day different?
Sure. I think some of the panelists already said it. I think the difference was we were in a borrower's market pre-COVID for sure. If you had something that you needed financing for, it was available and it was relatively cheap. I think what the market has certainly, gone to is in one sense a haves and have-nots market, right? So for high quality product with good sponsors, in good market, some of the nuances of what COVID has done, for that, there's capital available. Liquidity is not the issue, and we are seeing plenty of people on the sidelines. But there are players there, and there are players waiting to be there, chomping at the bit to get back in the space. The banks are in certain asset classes, so and the debt funds to have their leverage return so they can be back in the space. So it is what Paul said. It's been a little bit of a pricing premium. And so on that front, we've been steering people to match borrowers and lenders much more appropriately. Again, in a needs-based market, and recognize that there is pricing premium today. Now, what's interesting about that is if we look back, and Paul thinks maybe longer back history than I do, but I think we've reset back only a couple of years on certain pricing points, and some not at all, right? So on the pricing side, a deal that was L3, it might have been down, we'll take a hotel in a unstabilized hotel, L300 or so in January. Well, that was January, and we were in a very, very unique point. But only a year prior to that, that could have been as high as L500 or 450. And so the premiums that we're seeing, and they certainly exist, are a bit of part of the reset button that's gone on, which ultimately, we think do come down over time as liquidity continues to come into the system. And what it's doing now is presenting an opportunity for lenders who are active in the market to capitalize on what might be a relatively short-term situation. Now, there's a lot of ifs in there about COVID, about therapeutics, about certain markets, but we definitely see that this is a big, and this is the what we're all talking about. The opportunity set here exists for both buyers of assets and lenders to find unique positions in the markets or just be active in the markets to capitalize on that.
That's right. And I think to flesh out that same thought, the participation rate among bulge bracket banks, right, on the bridge lending side, that's what is out of the market right now, right? So a number of these big national lenders who were those line lending, counterparties, and who were also the A notes on a number of these transactions, they're not actively lending right now. It's really a confluence of two factors, right? One is just the amount of committed unfunded capital that they had out pre-COVID, right, on some of those lines that was fully drawn, right? We had one major national lender tell us they went from $11 billion of liquidity to $4 billion in a week, right? That's drawdowns both on those committed unfunded line lending obligations on the real estate side, also corporate credits, right? Corporate lines were drawn down pretty materially. The other factor is that on the heels of the longest sustained recovery ever, shockingly, we had very low delinquency rates. So correspondingly, someone was being very frugal and said, let's cut our servicing staff. Why would we have all these people on when we don't have any issues? So in in time when, with the flip of a switch, every hospitality deal that Midland had in special servicing, for example, right, in servicing, for example, was transferred to special servicing, right? Every single retail deal in the country was suddenly significantly impaired. All of those inbound forbearance requests just create a significant amount of work that needs to be done, right? So our expectation is that those national bank lenders will be back. They're working through those issues. And even if you think about a blended average, 3-year line commitment, which is usually a little bit shorter, there's more skewness to the front end of that. That means every single month you're returning 3% of that total committed capital, right? So that capital commitment is going to continue to refill bank coffers. You've got significant public money that's gone out. And I say it often, I don't know about all of you, but my checking account pays me about 2 basis points, and people are sitting at record levels, right? So where we've seen a ton of interest in activities on the local regional banking market, they have record inflows. They don't have the same legacy issues on the servicing side, and they also didn't have the line obligations, right? So those local regional lenders are stepping up pretty materially for us in an A-note format. Deal size is the bigger constraint. So you've either got to say, okay, we're willing to go and participate that out and bifurcate and do, co-equal lenders on an A-note, or we're doing an incrementally smaller transaction. I'd point to banks is having a significant amount of interest, both Southeast Asia and Germany, and then the life insurance companies, right? Life insurance have been highly active. And again, to Brett's point, you look back, and I think on the fixed rate side, we are locking new deals that are inside of 3%, 3 to 3.25 is I think where the bulk of that is shaking out today. That may be up from all-time lows of 2.7% we were able to effectuate in January and February. If you can't make money on your deal over a 10-year horizon at 3.25, I don't think it's the leverage that's impairing you, right? There's bigger issues at play. So Paul, just coming back to you, as you think about moving forward, right, where do you view there being kind of windows of opportunity that you think will persist for a while? And where do you think there's just kind of a narrow window right now to go?
It's a great question. I think for the most part, this is a narrow window. I know we all talked about a V-shaped recovery, and then we said, well, V-shape's not going to happen. And like you said, the public equity market and the stock market thinks a V-shape definitely is going to happen. We're obviously not out of this. I can give you 10 metrics that show me that things are getting better. We're seeing a better velocity of money in the marketplace. Money starting to flow again. You're seeing all the numbers that rents are being collected and all that. So there is good news out there, but still we got to understand that we're not done with this. We don't know if there's going to be a second wave. The PPP monies are going to run out, and what if people don't feel comfortable coming back to restaurants? So it is going to take some time. But all that being said, I do think the opportunity is not that long. I think we have a few months or a couple quarters where there is an opportunity for increased pricing due to the fact that a lot of lenders have pulled back. A lot of lenders are having liquidity issues and margin calls, and they don't have the ability to put money out there. But from our perspective, just our fund, and we're just one of many, we're seeing investor capital deploy again. For 2 months they were frozen. We don't want to put money into the market. We don't know what's happening. And now the last 3 weeks, we're getting investor capital almost on a daily basis. So that shows you what's happening. And we all know there's no secret out there. As a country, we're infusing $10 trillion into the system. That's going to trickle down. And we all know it's eventually going to get back into the hands of the players in the market, whether you're a lender or a borrower or a developer. And when that money flows in, whether it's in Q3, Q4 this year or sometime next year, there's going to be, again, a huge amount of liquidity that's going to compress pricing. So to answer your question, I think there's a window. I think it's a very short window.
Call Paul today and go lock up your deal.
I think it's really important point that was made. If you are a borrower, you need to ask your lender how they're financed, because if you're, as Robin said, dragged down by cross-collateralized repo lines that have mismatched terms from the underlying loan, that is putting the borrower at risk. So ask your lenders, if you are a borrower, how are you financed, or if you're financed at all. I just wanted to make that point and bring it home to the audience.
It's a great, I want to follow up. So Vicki, unpack that for us. So you I think have great diversity of capital and how have you all structured yourself in terms of times like this, being able to remain active and liquid?
I think she froze.
Froze. Unlike her capital.
Yeah. I mean, I can, Bill, if you want, I can answer it what we do, because everyone's a little different. So what we saw in the marketplace was a lot of our colleagues, they did freeze, because what happened was they had no liquidity, they had margin calls, they were leveraged 2x, 3x, 4x. What we do is a little different. We are a construction fund, so we need to have a little bit of a cash flow system, but our leverage is 10% of our AUM. Our leverage is so low that we were unaffected by this crisis. I think Vicki's back, so I'll pass it on to her.
Yeah, sorry.
Oh yeah, I'm back. Sorry, I'm having a little bit of internet. We sell A notes that are matched with our underlying loan term, and then we have additional time or some standstill language in there that we could keep that lender current in the event that the borrower defaults. And this is really a function of, I have Wall Street partners who have been repo lenders, who actually, one in particular, put another debt fund out of business in the 80s and early 90s, and we just never wanted to put ourselves in that position. So I think it's such an important point. Paul sounds like he's got a really conservative platform, and that's really meaningful. So that's the way.
I mean, we all know the way leverage works. I'll tell you my personal story. In 1991, I did my first development deal with my father, and we lost it to the bank. And what did I learn? I learned that leverage is good in good times, and leverage is horrible in bad times. Because when we started the project in '89, the market was great. In '91, we lost it. So what happened in '08? Personally, on a personal level, we were very low leverage, because we said, and not because we knew what was going to happen. We had no idea in '08 we're going to have a crash, but we were low leverage, and we came out of it much stronger. So prior to COVID, we all sat around. If we sat around and did the same panel in February, we would say, when is the market going to turn? We know the market's going to turn. When is it going to turn? We said this for 2 years, but nobody knew how it was going to happen and what was the catalyst. What was the catalyst that was going to create that downturn? So our viewpoint is leverage is great. It does increase your returns. It does boost yields. But at the end of the day, if you get stuck with too much leverage, the potential to take you down is way too big.
So I want to riff off a comment Paul made and bring you in on this, Robin. The remarkable feature of the 11-year cycle that denotatively ended, we are structurally in a recession, was that really got to a point of the negative and excessive leverage that you saw last cycle. I think we got hurt badly on crises that we created internally within our own industry. This is obviously exogenous. When you think about some of the decisions you all made going into this, we think about the way you structured yourselves and deals that you elected not to do coming into this. Now that the shoe has dropped, what do you look back on and say, okay, that's exactly why we feel very validated in our decision making?
I mean, I think you're exactly right. This is a very different type of crisis, and so a health crisis is affecting asset classes much differently than the GFC did, which really had a kind of blanket effect in terms of asset values. And what we see coming out of this is a much more differentiated effect by property type and by geography in terms of how a pandemic and shutdown and social distancing requirements is affecting each very differently. And so from a positioning perspective, right now, if you're sitting on a lot of multifamily and industrial, you're feeling much better than if you're sitting on a lot of hotel and retail, for example. We're, fortunately, we've been negative on retail for a very long time, just because it's going through it's been going through a secular structural challenge, unlike the other property types, given the rise of e-commerce. And now the pandemic has obviously really accelerated that issue, other than for grocery anchored centers. So we certainly feel like we're well positioned relatively from that perspective, because we did not have a concentration in retail. We've been positive on multifamily for a very long time, and the data in terms of rent collections that you're seeing right now across the different asset classes. Multifamilies currently at the top. It's averaged nationally about 93% rent collection, so only 2% lower on delinquencies than pre-COVID. And then when you also look at the data just from a broad swath of delinquency data in the mortgage universe, in CMBS, for example, you saw last month the highest spike in delinquencies in CMBS on record, up to just above 7%. But the dispersion that you saw there between asset classes was pretty phenomenal. So, retail and hospitality went to 10 to 19% delinquent, whereas industrial, office, and multifamily only had 1 to 3% delinquencies. So kind of, the portfolio positioning by asset class, by specific submarket, all of that is just so incredibly important because the challenges in a pandemic scenario have not created a one-size-fits-all outcome.
That's well said. And so, Brett, you've got a unique view of, we talked about retail, I think another asset class that individual, very interesting risk-adjusted opportunities are getting thrown out with the broader kind of frame. You have a national perspective and a broad product focus, but expertise within hospitality. Talk to us about what you're seeing in hospitality. Where are there opportunities right now that people should be paying attention to? What do you think is mispriced?
Yeah, I think on hospitality, we think that's where the most opportunity will be coming, and currently is in coming out of the post-COVID crisis. We put retail in the camp of pre-existing problems, and frankly, part of that just a falling knife situation. Hospitality, the situation specific right now and systemic. That there is most people, or at least we believe that we've in a unique case, you've seen the bottom, right? When there's literally the hotel is closed by nature, that should be the bottom. It's really a question, as I came back to, of the haves and the have-nots in that space. And so the opportunities are both on the asset purchasing side, as well as getting in, as we talked about earlier, on the debt side to capitalize on a couple of things that are really lacking. I'd say in overall, the hospitality space is clearly where there's been the least amount of lenders playing. And so those that are getting best in class structure, they're getting interest reserves, they're getting that premium, whether both the market-based premium for being the players in the space or the additional volatility premium, because while there's more transparency still, a lot we don't necessarily know. So I think that's an opportunity set on the debt side. Certainly we've seen a pullback in leverage. So the other opportunities are to fill specific voids in capital structures, be it traditional financings, and we are actually seeing now traditional financings, for hospitality needs that I'd say are, again, since we are in the post-COVID environment, they're affected by it, but they're not distressed, right? So they're just assets that happen to have maturities, and now need to, are more looked at as, unstabilized assets that need to find financing for them. I think people are realizing that, particularly in markets like the drive-to leisure markets, tremendous opportunity to play there. We actually just closed what we think is the first post-COVID sale of an asset this week. It was a lifestyle boutique hotel in Nashville, and that asset traded at probably what we think is about a 20% discount to pre-COVID valuation. And I think that's not a one size fits all, right? By nature, again, if people probably aren't selling assets with 50% discounts that would apply to them. But I think for core assets in good markets, that is the kind of discount that's available. And I think what we say to our clients is the discount, isn't necessarily what you should care about. You could get a 60% discount and it could be a terrible deal. A 20% discount, versus 3 months ago you liked the deal, now you kind of love it from a basis perspective, right? The standard deviations of losses have gone down, and that does trickle through to the lending environment. So we're going to see people, we're going to see a reset, and that's what we think this really is in the hospitality space. People have been predicting, a recession for a long time, and it's been accelerated. But from that, it's about participating in the right opportunities in the space, and hospitality will again offer the most, because to be the most perceived dislocation, but probably the quicker recovery within the space.
Awesome. So we have about 10 minutes left. We're going to open it up for Q&A. So there's a chat feature at the bottom, either in the chat or the Q&A. I'll try and watch both. First question, I'm actually going to just broaden out to all three of our lenders. So Robin, Vicki, Paul, leverage and pricing, round numbers, asset types that you would consider today. What is max leverage? What kind of pricing band are you solving to? You know, what's that kind of residual target?
Yeah, I can go. We max out at 70% LTV. And again, has anybody seen an appraisal lately? So we have to take a look at that. We like construction pricing. I agree with Paul, has widened 200 to 300 basis points from a couple of months ago. And you know, we want to see skin in the game and experience. So we like, again, asset classes that have demand and where we can, our basis is defensible in the long, if something for 8 to 6 months, we'll look at that. Who knows what's going to happen in the future, but we can get comfortable at certain levels. So that's where we are. I don't know what Paul thinks.
You know, a little bit has changed and a lot hasn't changed. So leverage was 75% of cost for ground up construction. That has not changed. Asset types was mostly multifamily, industrial. We look at retail and office as well. Maybe there's a little change there. So we're looking at a spec office deal in Denver. My team loves it. I don't, just because it's a spec office deal in Denver. But at the right leverage, at the right basis, every deal makes sense. So those are the things that have changed. Pricing, again, we were 8 to 10%. Now we're 10 to 13%. So that's the biggest change. But I think one thing that I know we all shared and we all talked about pre-COVID was you stick to your fundamentals and you do well during downturns. I don't think anybody's really making huge changes here. I think everybody's weathering a storm and maybe making some slight changes. And there will be bigger changes down the horizon, looking down 5 and 10 years in terms of the way the economy performs based on what we went through. But for now, our changes are just the pricing.
And for our platform, we're active in providing senior loans, mezzanine loans, and preferred equity in terms of debt structures. And so across each of those different places in the capital stack, we're a completely unleveraged lender. So we can either look at opportunities from a stretched senior perspective or work with our banking relationships to pair up and be a senior mezz or senior preferred equity option. Obviously, in today's environment, depending on the deal profile, that senior bank lender may or may not be available. So it's very dependent in terms of kind of structure and pricing and leverage level on what asset class and we're talking about in the sponsorship quality.
So our final question, and Brett, I'm going to have you start us off, and then we'd love to just go around the horn. What is the biggest lesson that you've learned from this crisis?
Wow. Put me right on the spot. I don't know, be in the market always. There's opportunities out there. I think, we were kind of pleasantly surprised over the last week at some of the change. I think every other day we're getting, maybe even more, getting calls from lenders that are coming back into the market again. And some of it's, just from the green shoots that are happening out there. But I think, we think that this kind of dislocation just breeds opportunity. We are finding folks, and again, this may be what people don't, and some of the other panels said it's not there, but we're seeing financing across the board for most things. Again, it's probably more of that pricing issue, but buyers, but we're putting buyers and sellers together. We're putting lenders and borrowers together. Hotel construction is actually getting financed. We're doing, tremendous, very, very cheap multi, as others have said, that, and the CMBS market is returning with, they're looking for velocity, and their pricing is, as you said earlier, 3.5% money. So, there's some surprising things out there that we're finding for the right assets, and those that have problems, it's interesting, this market, everyone is on both sides, right? Every borrower has a deal that they're both saying, I have a problem, and then they're also looking for the opportunities. And so I think, we're kind of obviously positioned well to facilitate both, and that's what we'll do going forward.
Vicki, lessons learned from this cycle or big takeaway?
Yeah, so I've been in the business since the late 80s. So this is my 6th market dislocation. I think I'm counting right. Human behavior is really interesting. I was out at this is maybe not a business thing, but it all peels up to where we sit. You know, people are walking around, crowding together on the beach in Malibu with no masks. Resilience of human beings to get back out there quicker than we thought. I talked to somebody yesterday who's a hotel guru, and he said that there's a hotel in Santa Barbara that was at 100% occupancy this weekend. So just the ability for human beings to be maybe a little bit risk averse than we would think, and to the social aspect of what we're dealing with is so wearing on people that people will put themselves at risk to really get out, and I'm sure the being home for a lot of people is wearing on you too. So I was just surprised how fast people got back out there. And the other thing, just from the 6 dislocations I've been in, is you just have to keep a clear head and have to, as a business person, have the philosophy that the world's not going to end. And then it's about what risk tools are you putting in place that are in addition to what you do every day. So that's really my advice and observations.
Robin?
I would think, from every end of the spectrum, you're just seeing how important balance sheet structure ultimately is, whether it's the balance sheet structure on the, just of the lender's capital, or the balance sheet structure of your borrower and how much liquidity they have to keep funding, carry costs and, maybe unanticipated, CapEx and pay downs during this time period. Because I think that ultimately, you may have assets that could have otherwise survived during this period of lower cash flow if the equity was able to make some capital calls, but it ultimately will highlight for those very thinly capitalized owners, needing to translate into forced selling activity, and for those that can keep writing checks, they'll be able to hold on as it recovers.
So Warren Buffett line of you find out who's skinny dipping when the tide goes out.
Something like that.
Paul, give us final thoughts.
It's something I alluded to a few minutes ago. I think that the most important thing, and everyone agrees, is you always have to stick to your fundamentals. And why do I think that's important is I think that we all know this was a very different recession than any of us had ever experienced. But what was most different about it was how unexpected it was. Every recession is different. Every economic cycle is different. Post 2008 and leading into even March of 2020, everybody was sitting talking about, I am making sure I'm doing the right things because I know a downturn's coming and I want to be prepared. And what did this prove? You cannot be prepared when you have no idea what's coming. So it goes back to exactly the issue of sticking to your fundamentals. If you do that during the good and the bad, then you'll survive any downturn. What did we do when the market crashed in March? We sat around the first week of April and we said, hey, let's do a stress test on our portfolio. And we started looking, and the last 12 loans we closed were all fine, but the pricing was a little low. And you sit there and you go, what were we doing? Yeah, we did great loans and we'd probably do the same loans, but why'd we get so aggressive with the pricing just to put the money out? So if you stick to your fundamentals and you do the right deals, no matter what the next downturn is, or no matter what the next pandemic is or world issue arises, you'll be fine. So it's hard. It's really hard to stick to your fundamentals. You get pushed one way or the other in terms of leverage or pricing, or, hey, you know what, let's do hospitality, even though we don't know anything about hospitality. You just can't do that.
And look, what I'll add, which I hope isn't a new lesson, I think it was absolutely a reaffirmation. I see his name coming up, so I'm going to brag on him because he wouldn't brag on himself. Do business with good people. When it really comes down to it, it's a cliche to say this is a people business, but the dynamism of the past few months, I think, has reminded all of us that we are operating in a market. It may not move as quickly day to day as you sometimes think it could, but in the scary moment in time, Peter Sodoloff stepped up. We had a transaction we've been working on for months, and they closed with a very thoughtful, creative, kind of good faith structure on a tremendous deal, right? And it's one that 3 years from now is going to be, fantastic opportunity. But this does come down to people having a counterparty that you know and trust. I mean, that's important. So, Peter, thank you. That is our panel. To our panelists, thank you all very much for your time. Thank you for the questions, and thank you, Commercial Observer.
Thank you, Bill.
Thanks, Bill. Thanks, everyone.
Thank you, Bill, and thanks to all our panelists for another great panel and great insight there. Our next panel is entitled Game of Loans, Lenders of All Stripes Take a Gamble in a Shifting Market. This panel is moderated by Val Octomar, Executive Vice President at CBRE, and Val is joined by Toby Cobb, co-founder of 3650 REIT, Abby Franchot-Borok, Head of Originations at Amherst Capital, Kyle Jeffers, Senior Managing Director and Head of Originations at Acor Capital for the Western Region, Charlie Rose, Managing Director and Portfolio Manager at Invesco Real Estate, and Peter Sodoloff, we just got a shout out from Bill there, Managing Partner and Chief Investment Officer at MAC Real Estate Credit Strategies. Over to you, Val. Thank you.
Well, thank you so much. And I'd like to say good morning for everyone on the West Coast, and I guess good afternoon for those on the East Coast. Also, before we start, I'd just really like to echo Tom's comments about the need for more diversity in our industry. I really think it's something we all need, we're all fighting for and advocating it. And I think we need to do large and small things to improve diversity. And also this panel is great. We've got some diversity here and throughout the whole program. So it's a very admirable goal. We've got a very experienced and creative panel. I think it'll be interesting to hear all their insights. We'd like to start off maybe by just having each panelist introduce themselves briefly and give a short overview on their firm's sweet spot and strategy and what their role is. So Toby, could you start?
Sure. Hello, everyone across the nation. Thanks for having us. My name is Toby Cobb. I'm the co-founder and co-managing partner of 3650. We are an investment manager. We have 3 strategies. We have real property in predominantly in Miami, Florida, where we own about 2 million square feet. We have 2 debt platforms. One we call Bridge and Event Driven, which is dominated by assets in transition and some construction. We also have what we call stable cash flow, which is the origination of 10-year fixed rate loans financed by the issuance of commercial mortgage-backed securities, but where we retain the majority of the classes that would be below AAA in the capital structure. So we just principally use CMBS as a financing tool. So happy to be here, chat.
Thanks. And Abby?
Sure. Abby Franchot-Borok. I'm with Amherst Capital. Amherst is a real estate investment specialist. We have about $6 billion assets under management across our debt and equity strategies. Our commercial real estate debt platform focuses on providing middle market loans to institutional borrower sponsors, primarily backing transitional and value-add business plans.
Kyle?
Hi, Kyle Jeffers, Senior Managing Director at Acor Capital. I run the West Coast Loan Originations. We're a balance sheet bridge debt fund. We have about 16 billion of AUM currently, all in the debt space, no equity arm. I think in 2019, we did about 7 billion, really 3 products. We're a light value add, heavy value add, and construction. I think this year we were targeting something similar, and who knows where we end up.
Mm-hmm. And Peter?
Hey, great to see you all, and I hope everyone's doing well. Thank you for your comments, Val, at the beginning. It's completely echo and agree with your sentiments on diversity and a lot of work we have to do. So I'm Peter Sodoloff, co-founder, managing partner of MAC Real Estate Credit Strategies, institutionally capitalized lender. We run probably a top 3, top 4 public or private vehicle that does large transitional mortgage loans. We've done about 15 billion of originations the past 5 years. Last year was pretty active, a little over 6 billion. Year before, close to 6 billion. We also provide, through a higher yielding strategy, mezzanine, preferred, rescue capital, buy distressed notes, and also during the past few months, buy securities, CMBS in particular. Pleasure to be here, and thanks.
Thanks. And finally, Charlie.
Thanks, Val. And I would echo Peter's comments and yours as well. We are glad that the conversation has emphasized anti-racism and anti-bias, and that conversation is becoming part of the ordinary course of business. It's an important one to have. My name is Charlie Rose. I am co-portfolio manager and managing director with Invesco Real Estate. Invesco Real Estate is the real estate direct investing arm of Invesco Limited, a $1 trillion investment manager based out of Atlanta. Invesco Real Estate comprises just under 76 billion of AUM. And one of our key areas of growth over the last several years has been our debt business, which we view as very complementary to the core value add and opportunistic equity businesses that we have here in the US as well as globally. In 2019, we originated a little over $3 billion of product, and our goal this year was to originate $4 billion. Again, as Kyle mentioned, we'll see where we end up, but that feels extremely optimistic at this point in time. Our niche in the market is as a relationship lender focused on credit over yield. So we characterize ourselves as a core plus debt fund, generally focusing in that 60 to 65% LTV range with institutional quality assets, institutional borrowers in major markets. And generally speaking, the majority of our activity historically has been multifamily, office, and industrial.
Okay, thank you. Well, obviously, we've seen a big shift in the market. There's less liquidity. It's more inefficient. Underwriting has changed. Pricing has changed. And yet, you know, we've all got portfolios to deal with and clients that we want to keep happy. And there are some opportunities. I think it might be interesting to start right now, first of all, with how your businesses have changed from pre-COVID to today, if you're changing any strategies, and also whether you're open and how you're really dealing with the shelter in place. I know some cities are open and others are not, but maybe we just start off briefly with how your businesses compare pre-COVID to today. Abby, do you want to start with that for a bit?
Sure. Well, the markets have slowed. So as transitional lenders, I think just given that the acquisition market, investment sales market drives a lot of our activity there, there has been a slowdown there. I'd say the first 6 weeks of the pandemic was we and many of our competitors were playing defense and making sure we were focused on the portfolios, existing portfolios, and as May progressed, began to look at other opportunities in the market. I would say our two focus points right now is providing, looking at opportunities with our existing institutional equity partners who are seeing some interesting opportunities in the market and providing them new originations. And then additionally, there are a number of loan portfolios out in the market, primarily driven by liquidity issues by other debt funds. And we're underwriting some of those and understanding where the market will be for, as we'll see more in that space going forward.
Okay. And Toby, your team has been active quoting a lot. You guys are probably open first in Texas, but what are you seeing right now and how have things changed?
We definitely were searching for value pre-COVID, right? We were finding it in further corners. We frankly had to do more construction lending in a pre-COVID environment where we have a vertical development division, so we can deploy some of those assets to monitor construction draws and the kind of things that it takes to be a construction lender. During COVID, we enjoyed a bit of a unique spot because we didn't have any warehouse financing against our portfolio, and so we were a little bit, I think, on our front foot. But I would echo what I think we're going to hear from everybody. For 4 weeks or so, we were all watching very carefully our existing portfolios and what was happening in the world. I don't want to give the sense that we were cowboying out there in late March and early April, but we did get on the front foot a little early. We closed a loan today. We closed a $35 million loan today in our transitional bed business. We're closing 3 loans next week in our stable cash flow business. I think the real opportunities are liquidity driven, right? As Abby said, that either they're liquidity driven because they're on a portfolio that was financed with short-term floating rate repo type financing, and that lender has gotten a margin call, and they've had to raise liquidity by selling assets, and those provide opportunity to buy those assets at below par, of course. And then there's liquidity driven by the few transactions that are getting done on the acquisition side. Lenders have been sitting on their hands for the most part, and so we have 3 of the 4 deals that we're closing this week and next week are acquisitions that had timing hurdles for the buyer, and it provided opportunity for us to get what I would say is a very attractive and conservative loans at rates that are 200-300 basis points wider than pre-COVID. So liquidity absolutely has been the predominant opportunity post-COVID. Very little, true distressed opportunities thus far. I think there's a lot of people that are in a wait and see mode, even in assets that are truly, challenged now, like a hospitality asset that has, little occupancy and in a tough spot, or a retail asset that has no tenants paying. Very little, I think, in the way of transaction around those kind of assets thus far. There will be, and there will be some assets that are going to have some really deep problems. But I think we're in a wait and see mode, all of us, on those assets.
Right, Peter.
Yeah, look, we've always positioned our business to be kind of secure and safe for a market like this. I always call it the financial crisis type market, and that's a number of strategies. One is, picking the right assets, right markets. Can't always get it right, but trying to. And then sponsorship in the way of quality, commitment, reputation, scale, but also the basis at which we're entering into the real estate. So most of our portfolio is generally large loan. We don't do small balance, CLO based models, secondary, tertiary markets. Not that that's a bad business model in any way, shape, or form. It's just what we've been doing this many cycles. That's kind of, it plays to our strengths as owners, operators, managers, developers on the equity side of our business, and frankly the originator side of our business. So thankfully, we've been in good shape. We obviously saw how some people were financing themselves, and some of the credit decisions they were making were they were overstretching for what looked like high quality assets, but then on the right side of their balance sheet, kind of getting that wrong, which I think was on a prior panel I got the tail end of. History often repeats itself. Definitely wrong. You kind of see that same strategy, securities and potentially public vehicles, margin calls, those types of things. So we were also as an organization, very negative, just knowing that we didn't know what it was, nor do we anticipate this. But if you were at our annual meeting, we just said, this is ending, this is going to end, and it's going to end badly. And so I think that served us well. I would say that we've really been, over the past 3 to 4 months, and it's amazing how just 3 months ago we were celebrating all-time low employment and the cycle that wouldn't end, and stock market at all-time highs. I think what's interesting here is we really took an inward focus and made sure all that the hatches were battened down, liquidity shored up, we kept a lot of liquidity already. Obviously the expected requests from borrowers, which we'll talk about. But we've also been able to close with some key relationships, some very good credits, and very different pricing, very different detachment points, and really, on assets that we think, if we believe that at some point we come out of what we're in, we all don't know what values are, we don't know what cap rates are, we don't know what appraisals are today. I think, even the best of us, transaction volumes are way down. that coming out of this mess, that those assets will stand the test of time, and the sponsors will show commitment over a long-term view, not a short-term view. I think that's really what has resonated. That's included some rescue opportunities in New York City on office, believe it or not, where the sponsor needed liquidity elsewhere, and also some markets like Nashville as well, where we were able to provide value-added solutions, and San Diego, and also San Jose.
Kyle.
Well, I think besides the obvious stuff, which is we took the majority of the origination staff and turned them into asset managers, and did probably what everybody did, which is re-underwrote your whole portfolio and tried to figure out if values are down 10% or 20%, what am I looking at and where am I risk? And, I think everybody did that right out of the gate. So certainly that changed the business. But I think what we're going to see now is we went through a period, if you go back to coming out of the financial crisis, the 2010, 2011, lenders have leverage. We have discipline, we have reserves, and we have structure, and we have AM. And over time, I think most of us on this panel are actually at different firms that probably didn't exist in that time. So all these debt funds have been raised, tons more liquidity in the system. That results in more competitive nature. You get less reserves, you get less structure, your credit metrics go down a little bit, your pricing gets compressed. And we continue to, over time, 10, 11, 12, you continue to go up to today. Things were getting really aggressive. And I think if we're all competing on a deal, you kind of convince yourself, oh, do I really need that cash trap, or do I really need that reserve? I can probably get away with this cap on this, or something to just win the deal and get it, as opposed to not putting the money out. And so I think what we're going to see now is it's that time in the cycle where it flips back. And now we, the lenders, are back in control a little bit. We have a little bit more leverage because not everybody's in the market and not everybody's pricing the same. And we don't really know where the market is. So it's going to go back to having good relationships and guys trusting you, and you've done the right thing by them. And likewise, they've been good borrowers, but we're also going to be more disciplined in the system. You're going to see more reserves, more structure. And so I think the biggest change that we're going to see, at least on our side, is where we got more aggressive in the past, even on more aggressive asset types or bigger business plans or bigger leaps of faith. I think that all comes back and it goes to the, swings really drastically to a real conservative side. And then we'll start to loosen up a little bit. But I think for us, we're going to see better loans, for us, better pricing, better returns, more structure, lower leverage, better borrower. So all in all, the net result for us is going to be better loans.
Thanks. And Charlie, I know you're out there winning some construction loan business and quoting on some good stuff. So what are you focusing on now?
Yeah, we remain active. I think similar to a number of folks on the call, we built our business to thrive in periods of time like this. And as Kyle mentioned, frankly, we were frustrated later in the last cycle to see the pressure on credit standards and structure that there were things being done in the market which were inappropriate from a credit perspective. So phases were very similar. In March, we were focused on keeping the deals that we had in our pipeline together while starting to re-underwrite the portfolio to make sure we knew what we had in this new environment. And like Peter, we were able to successfully close the loans that we had committed to, which was fundamental to us, our business, certainty of execution, and as a relationship lender. And just again, looking at the phases of this cycle, we have since closed a handful of loans, and just this week we signed up 3 new deals. So the pace of activity is definitely increasing. We are seeing the same on our equity side. For almost 2 months there, our equity pipeline was canceled entirely. And every week it was an update on collections and leasing activity and asset management efforts. We now have several deals going to investment committee on the equity side next week. Almost all industrial and medical office. So the box is smaller for sure. And our box on the lending side is smaller for sure. But it is our view that this is a point in time when there will be some winnowing of the market. And if we pick our spots carefully and do what we set out to do as a relationship lender, being present in the market during a difficult time, having appropriate structure, that will pay off for us in the long run. I would note on the office side, that was a question that came up. We are still largely work from home. We did a survey internally, and 2/3 of our employees, and this is Invesco US, so this several thousand employees, stated that they prefer to return to the office later rather than sooner. I think people, everyone, the vast majority of employees want to be back in the office full-time or close to full-time eventually. But folks are cautious and want to take the proper precautions for being back in the office. So we don't really anticipate much of our team being back in the office anywhere, whether it's Dallas or New York or California, until after Labor Day.
And I think our families really want us back in the office. We've taken over the home, so it's too
Absolutely.
much real estate work, right? We can constantly get that complaint. So I think the liquidity crisis in the mortgage REIT and the bridge fund market, really highlighted the importance of the capitalization of the bridge lenders. What are some of your advantages, or what strategies are you doing? I mean, as an advisor, we're seeing a lot more of the quotes all come on an unlevered basis because they're certain about the A notes or their warehouse lines. But I don't know, Abby, maybe you can talk about the strategies that you did, and then anybody else jump in as well. But it's certainly a big issue right now.
Yeah, sure. I mean, I think some other panelists have hit on this. You have to watch your leverage, and there are different ways, and we're all providing levered returns, whether it's through selling A notes or co-originating with an A note lender, whether it's CLO financing, whether it's warehouse financing. There are different ways to do that. The majority of our book is term financed in a CLO. So that is something that and we're special servicer of that CLO. So I would say, have been able to address our borrowers' needs within that structure as we worked through our portfolio, and specifically our hospitality and retail assets. Again, we're very focused on our borrower quality across our business. Strong sponsors and tight structure have always been a focus for us. Loan to cost and the right equity alignment with those borrower sponsors is also, is arguably one of the most important underwriting criteria for us. So for all those reasons, we've been able to work with our borrowers and feel like we have the right alignment to get through this unforeseen period. And I would just say that, the warehouse lenders have had to come in and remargin those lines. We are lucky that was not a large exposure for us.
Anybody else want to add their strategy or what they're doing to differentiate themselves right now?
Yeah, I would just say that there was, again, going in later into the cycle, people became, memories are short in this business. So we would be pitched constantly from repo lenders on the street, and we would hear this refrain: there have been no margin calls in repo 2.0, or there have been very few margin calls. And I just think that people, some lenders in the business were a little bit desensitized to that risk. That has always been a huge focus of ours, not having margin rights. It's important to our business as a relationship lender that our borrowers aren't at risk of waking up one day and finding that all of a sudden they have a repo lender as their lender that they weren't even aware of. And that can happen very, very quickly. So the other key aspect is having multiple ways to finance yourself if you are a levered lender, because there are participants, a lot of the largest participants in the market are now out of the market. And if your business is a flow business where you're trying to take advantage of opportunity in good times and bad and be that steady hand in the market. You need to have options to finance yourself.
Maybe we pivot and talk a little bit about new opportunities and deals we're seeing and deals you're interested in. And obviously, it's no longer a borrower's market. The market was very frothy and competitive in January and February. But curious to hear what you're seeing in terms of pipeline, what's interesting you right now, and where your sweet spots are. I know it's harder to place money and more targeted, but I think the audience would like to hear what you guys are focusing on and what you think will be getting done in the next few months. I don't know, Kyle, do you want to start with that one?
Yeah, sure. I mean, I would say just in the last 2-3 weeks, our pipeline has expanded exponentially. We were, obviously when this first started into February, early March, everything just went silent. And then you'd have a few guys trickle in with deals that were really desperate and needed financing. And then everyone else just put it on hold. And I think as you've seen a little bit of thawing around the country and things are getting back to normal, a lot of that volume has picked up. We've seen a lot of construction, which is not surprising. I think guys that have their entitlements, they have their GMP contracts and they're starting to get ready to build. They're not really concerned that we're in a recession or going into a recession because they're looking, well, we're going to deliver to 18 months or 24 months later. Why don't we go ahead and get this thing started and get it built so that we deliver in 2 years, the world will be back to normal. So we're seeing a lot of construction, which I think from our perspective, you actually where, to our earlier points, it was things were getting a little more aggressive. I think now we can dial back the leverage, we can increase the pricing, be a little bit more disciplined in our credit structure and get better loans and still be putting money out over time. So the construction loan opportunities are pretty interesting. We're seeing a bunch of multifamily, I think. We're not seeing the hospitality loans the opportunities coming in at all, obviously. My personal view is that you have guys that did hotel loans, and if they did them 18 months ago or 2 years ago, in the next year, 18 months, those things are going to come due. The lenders they're not going to meet their extension options, and depending on who the lender is and how they're financed, they may or may not be able to work out a pay down to get an extension. I think you're going to see a lot of hotel loans looking for rescue capital, looking for mezz. They had a $75 million loan. They go to refi in 18 months and they can get 60 million and they're short 15, 20, $30 million. I think that mezz component is going to be really interesting in the coming 6 to 12, 18 months. But overall, I think it's, the volume has been starting to pick up, and I think you're going to see a little bit more opportunities as the market starts to thaw.
And sweet spot and size for you guys?
We're generally 100 to 200. 50 to 200. So, kind of 100 millions right in the sweet spot. If we're 150, 175, 50 to 75, kind of right in that range.
Mm-hmm. And Toby?
I think that because we have not used leverage in our bridge strategy, right, and will continue to not use leverage in our bridge strategy, we have been targeting a different asset class, I think, a lot than others. We tend to have assets that have a more material transition or full-on construction, right? We tend to do the full capital stack, so we're lending through what would be the mezz component, right? And while post-COVID, we're going to be able to shift that a little bit, right? I still think that's the place where we will find some real interesting opportunities. So I guess I would agree with Kyle that construction lending, will be an interesting place for us. But, we're also finding this deal that we just closed today was, light construction, but closing contract and close a loan from app to closing in 3 weeks. So, timing was the real opportunity in that origination today. So that's a multifamily deal. I think that this business is idiosyncratic and our origination is idiosyncratic. And so I think that that's the way it will continue. And frankly, the ability to be in both the stable cash flowing lending business and the bridge business enables us to, talk to a lot of clients. And when the idiosyncratic asset that shows up that we think we can get both safe and attractive yield, that's where we end up.
Mm-hmm. And Peter, you've got a lot of different strategies going. How's your pipeline looking, both on the development and on the financing side?
Yeah, thanks, Val. Yeah, we have a lot of areas that we can focus on. I would say I'd bucket it in 3 or 4 buckets. One is, like many of the panelists, opportunities to provide rescue financing for projects where they've hit a balancing issue, maturity, et cetera. And those are definitely, or they have liquidity issues elsewhere and they can offer up, interesting assets perhaps that they have elsewhere. So we did an interesting deal like that in New York City recently. We gave $100 million of mezz, structured in a very unique way, at CMBS debt ahead of it, very low basis on an well-occupied office asset, very wide yield post-COVID. And the individual needed that to provide liquidity on some other things that were in his portfolio. We also have another area which is more corporate. So we provide rescue financing for some of these mortgage REITs and others. We understand their assets, the corporate structure. So that's definitely been keeping us busy. So it's more of a corporate rescue play there, where we can add value, move quickly. The other theme I would say is legacy loan purchases. We definitely are seeing it's not prolific, but a number of pickups in portfolios, assets that we like. And so we expect to see more of that, frankly, but we're digging in on a number of large situations right now, and allows us to deploy on assets that are already structured at some discounts. I think discounts haven't gotten really where everyone wants them to be, but on some midstream construction projects, actually, where there's some loans, you can get some pretty interesting discounts, just given it's not for everyone, and there's a lot of execution risk there. And then the final area that we're seeing interest in was securities. We did invest in certain real estate securities during the dislocation. Not so much now, but we do expect there to be more volatility, as we can see, like today. The movie isn't over, and we believe that there's more to come, despite some green shoots that appeared over the past month. So that's kind of what's keeping us busy.
Mm-hmm. And you're happy with the returns?
Yeah, look, I think for a first mortgage transitional loan, it's bread and butter, similar to what I think Charlie does a lot of. That's, a multi-transitional that used to be L250 and had 20 guys or gals, competing. That's now repriced to, 100 to 200, in some cases 300 basis points, leverage levels down lower, and less people showing up. So we do like the pricing. Frankly, when we started our first mortgage transitional business, I don't know, 5-6 years ago, we think the pricing's even better than it was then. And so it's been interesting to see, although we are being, I would say, thoughtful and cautious. We're not full in. We're picking our spots, picking our sponsors, and being very deliberate with the situations we come into.
And still sticking with a LIBOR floor of 1, basically?
Yeah, I mean, I think that what's interesting is on our legacy portfolio, our average floor rate is close to 2%. And a lot of our deals have a lot of future funding. Yeah. So that's been its own interesting gift that keeps giving. Our average loan to cost is 60%. So clearly there's a lot of sponsor equity, borrowers doing the right things, but that's been also a pleasant surprise. But I think borrowers have been less sensitive to floors and just picking someone that can show up and get their deal done based on facts and circumstances. Definitely less picky these days.
Okay. And Abby, how's your pipeline?
It's robust. I mean, we're seeing opportunities across some of the spectrum that the other panelists have spoken to. I would add one area of focus for us, and this was a very active part of the market and part of our business for our team coming out of the last cycle, is note-on-note financing. So we have a lot of expertise financing institutional equity groups that are buying debt with a loan-to-own strategy. So we would finance those groups and see them through that loan-to-own process. We've got expertise underwriting, the time it'll take to get to fee, and then even seeing those groups through the business plan post taking fee. So that's another, while some of that distress, we think it's going to take time to really, for those opportunities to really present themselves in mass for many of our institutional equity borrower sponsors. We do think that will be coming, and we're focused on that business segment as well.
Great. On a number of deals that we're out on, we're noticing, the money center banks not being as aggressive as they were. I think a lot of credit lines got pulled down and just not seeing them be as offensive. Seeing community regional banks step up, and actually Lifeco step up quite nicely on some of the core plus or value add. When do you think the banks are going to really come back? How do you think? What are you seeing, Kyle?
It's a good question. I mean, we don't use a lot of bank financing. We're kind of a whole loan lender, similar to what Toby was describing, where we don't use much repo or warehouse facilities. Most of our separate accounts are whole loans. So we don't sell a lot of A notes, or we haven't used them a bunch. And the guys we're talking to, I mean, they haven't it's kind of one of the unique aspects of this is, like for us, we expected probably a third of our portfolio would have rolled off this year through loan maturities or sales, or, we're a value add guy like most of us. And guys complete their business plan, they sell the assets to pay off. You got to redeploy the capital just to keep your AUM level up. The interesting thing is that because no one's paying off, the portfolio is actually, from an AUM standpoint, is staying at a good level, which helps us generate fees. And I think the banks are realizing the same thing, as we don't have payoffs. If they're at a level where they're comfortable with their CRE exposure, they're not going to go out and make new loans because they don't want to grow it, and they're not getting any payoffs. I think as you start to see the market start to transact a bit more, and you start to see guys, as the lenders come back into the market, then you see the investment sales market start to ramp up. Then people start paying off their loans. Then you'll see the banks, they're relying on those earnings for the money that they put out. When those loans start to come back and they need to generate earnings, they'll start to put money back into the market.
Okay, let's do a quick lightning round just to kind of break it up a bit. Do you feel your business strategy right now is more offensive or defensive today? Abby?
Offensive.
Offensive? Peter, I know the answer there, but.
Yeah, exactly. We're always defensive, but we see some really good opportunities. We're just being thoughtful about keeping a long-term view, and we think there's a lot of pain ahead, despite, unfortunately, people's best wishes.
And Toby?
Tale of two cities, right? We're going to be more offensive in our cash flowing, stable cash flow assets, where we're lending on multifamily industrial, necessity retail, like grocery anchored. We think there's interesting opportunity to lend there because the banks are out, right? And this term funding is a good place to go, right? Over on the bridge and event side, I would say we're always defensive, a little bit like what Peter said. We're very careful. We only do, a dozen transactions a year. And we're probably more defensive now than we have been, because it's, a little scary. Every asset relies on a business plan for a borrower to execute, right, in that space, right? And executing on a business plan is more challenging for borrowers in this environment. And so, we would definitely say we're both conservative and aggressive in our two different strategies, but appropriately so.
And Charlie?
Yeah, we are offensive in terms of our primary focus is deploying capital. We are defensive in our underwriting. For the debt fund, our mantra is credit over yield, and that is the focus. We are upgrading credit metrics on each loan relative to what we would have done on the same deal pre-COVID, and we are doubling down on our focus on institutional sponsors, institutional real estate, highly liquid markets, innovation centers, where I would say the new offensive focus has arisen, and you really need to know who you are and what your strengths are, but is in that rescue capital, preferred equity, high yield space, where we will invest out of some of our equity vehicles and separate accounts. But it does feel for the moment that the focus is on originations, with a very keen awareness that COVID is not over. There are hospitalization rates are spiking in certain areas. That risk is not done. There is a huge disconnect between Main Street and Wall Street right now. which is very concerning. And we're going into a very contentious election cycle. So there are a lot of downside risks, which don't seem to be reflected in the public markets, and we're structuring deals accordingly.
It brings up a really good point. I think workouts, restructures, forbearance, discussions with borrowers that may be struggling. I think a lot of tenants are having trouble paying rent in certain sectors, retail, hotel. So what strategy are you doing right now? I know everyone spent a lot of time on their existing portfolio. Are you seeing many workouts yet? Are you doing a lot of forbearance? How is that really translated within your organization? Kyle, maybe you can start first. I know you've got a lot of on balance sheet.
Yeah, sure. I mean, I think first of all, you have to remember the relationship between the senior lender and the equity. You know, the equity guys get all the upside, the senior lenders get a coupon and the downside. And so we had to, I think, sometimes re-educate some of our borrowers who immediately came to us and said, hey, wait, you know, the COVID's happening, my hotel's empty, or my tenants aren't paying rent, you lender have to defer interest. And we were like, hold on a second. You know, we want to be good partners and we want to help you through the tough times, but it's not necessarily a lender risk that you can't pay your loan. And so you had to work through those situations. And we kind of took a tactic that we looked at every deal individually, we looked at our sponsor, we looked at our property, we looked at the value, and we tried to come up with something that was fair, but it wasn't, we'll just take the pain and you guys will be okay. It was, you come to the table with some money, we'll come to the table with some deferral. Let's work out a deal so that both of us are participating. We'll be your partner and help you through this time, but we're not taking equity risk. At the same time, we'll defer some payments, but a lot of times we would say we'll defer for a couple months, but maybe we'll defer 50% of your debt service. You'll pay 50%. So you're coming to the table. It's not such a burden on you. We're giving you a little bit of break, and then we'll work on a business plan. We're able to, you know, maybe move some reserves around or play with some extension tests to ease some of the burden, because, you know, from the borrower side, it wasn't really their fault. They hadn't done anything wrong. This was an unforeseen event. So we don't want to be unfair in that respect, but we wanted to also, you know, the equity guys are looking at it saying, hey, I have these investors and I got to protect my investors. Well, we, the lenders, also have investors. We also have a fiduciary responsibility. So we have to make sure by just giving someone forbearance that it's a fair deal for them, for us, and for our investors, to make sure that we cover our basis and are protected and are not taking the additional risk by being a good partner to our borrower.
Good. Anybody else want to add what they're doing in terms of workouts and restructures?
I like what Kyle said. I mean, it's just spot on, right? Like, yeah. We all have investors, and I think that borrowers in the community, the borrower community at large, forgets that, you know, in almost every case, you know, in the group that's on the panelists today, there is a fireman or a teacher or a pension plan who we are acting as a fiduciary, right? And we are the first lien. And I think that, you know, the challenge, you know, around protecting their capital and doing our job, right, has made this very difficult, very, very difficult. Right? I tell a story sometimes about this borrower that has a $100 million loan. It's 57% loan to value on $175 million, you know, appraisal. It's $138 million construction costs. Beautiful asset, super conservative, 2.25 times DSCR going into COVID, right? And that borrower approached us for relief, right? And we feel like, wow, that guy didn't do anything wrong, right? But on the other side, there's a borrower that took $15 million, $18 million out at closing, right? And is extremely well heeled, has you know, the ability and the capacity to protect their asset. You say, you know, that's the same borrower, but you got to treat them like you're in the first lien position. So it's yeah, it's been tough.
So maybe what we'll do is we'll end up, first of all, I want to thank everybody for working on this with the Zoom. It's a little harder to be interactive, and I think it worked out well. So we'll do a quick lightning round and then open it up to Q&A. But I always like to be a little positive at the end. I know it's we've got headwinds, but we're all getting deals done. Interested in just lightning round, you know, your forecast for the rest of the year in 2021. And also if you have any thoughts on silver linings of this COVID. And then after that, we'll go right into Q&A and do a few questions. So Charlie, do you want to lead that one off?
Sure. I think it's very hard to forecast 2020 and 2021 on all fronts. We've just been going through the valuations exercise on our portfolio and debating cash flow projections. And there is just more uncertainty than we have had in the past. We had projected originating $4 billion of floating rate loans in 2020. In the first half of the year, we'll do less than $1 billion. Right now, our pipeline has picked up and things look positive. But as I mentioned, we're going into potentially a pickup in infections later in the year and an election year. So I anticipate that through the end of the year, it's going to be a depressed year for originations, but not as bad as the first half. In terms of you mentioned kind of bright spots. For me personally, during this period of time, it's just been a huge exercise in gratitude. How fortunate we all are during this period of time on so many fronts. And I've had so many conversations with our relationship borrowers to that end, where typically we'd be, talking about the last basis point and dollar terms. And I think in some ways, the extreme events in this 2020 period are actually bringing people together. And that's been a silver lining for.
That's very well said. Abby?
Yeah, I'd say silver lining for our business is I think many of us here built our businesses coming out of a time when banks had pulled back and there was gaps in the market for financing. And while it's a different scenario, I think there are going to be opportunities for us all to grow the business with, smart, creative financing solutions for our clients. The usage of space is going to change across asset classes, whether it's office or hospitality or even multifamily. And, that lends itself well to transitional and value add lending, whether you're buying an asset and making it open floor plan, more dense office space, or now you're going back to more, segmented offices. That's still a transitional value add business plan. There's going to be a lot of change in the way people use real estate because of COVID, and that's going to present opportunities. And then on the personal side, I would say the silver lining is I've got to spend a lot more time with my 4-year-old and my 10.
Right.
I'm in New York, and I was on the West Coast probably 5 times in January and February, and that's completely different now. So
nice.
Silver lining.
And Peter?
Yeah, I have 2 interesting takeaways. One is if you would have asked me how borrowers in our portfolio might behave pre-COVID if something like this happened and how they'd behave, sure, they'll ask for a thing here or there, but in terms of commitment and dedication, I've been, and who knows if we have another leg down or whatever, jury's out, but the responsiveness and commitment to their assets, I think, have been surprising to all of us. So that's like an external silver lining. I think the second area that's very interesting is internally, we have an asset management team, and a legal team, a compliance team, a fundraising team, a origination team, and we, as many of the group, we repurposed a bunch of our origination team to be more closely aligned to do asset management and survey and re-underwrite, et cetera. And I think that really created for our 35 people in my group and across, about a 240 person firm, it just created a setting for just a much deeper level of collaboration, trust, and people showing a great teamwork despite the technology issues, and really showing a focus and dedication, which is, I've been very proud of the team for doing that.
Great. Toby?
Little different, is one of the things I think I've been really pleased about is the performance for extended stay and roadside hotels, right? Like amazing occupancies and obviously a function of people wanting to get out and drive and go someplace, right? So that kind of took us by surprise. We have fairly low leverage on the maybe dozen, roadside or extended stay kind of hotels in our portfolio. And they're, you put lower leverage on them because they are a volatile asset class. Historically, they've wildly outperformed expectations during the last month and a half, right? So that's kind of been a big surprise. And then I guess I have to echo the travel component of our lives, right? We have offices in New York, Miami, LA, Chicago, Dallas, and Nashville, and I'm responsible for traveling and seeing all those people all the time. I was on 79 flight segments in calendar 19, right? And you couldn't imagine how much of your life that was taking and how much you can get done on the Zoom. So travel has been a really big and interesting new component of life.
I agree. And Kyle?
I guess I would echo, the seeing your kids more and just being grateful for how lucky all of us are. From a silver lining, from a professional standpoint, I think it's been interesting for a lot of the things that we rely on in our heads, whether it's loan to value or loan structure, whatever. We go, oh, this will be safe because we have this, or we have this borrower, and all those things have been tested. And so it's just more of a learning thing. We learned a lot in the financial crisis of ways we did deals and things we structured, and some things didn't work. And so we didn't use those again. And so now we're running them through a test again to see what works and what you learn. And so you just become smarter and can do things that are a little bit better. And then you have a lot of guys, I'm sure all of us do, that are out of school and been 3 or 4 or 5 years out of school, and they're coming up in their career, and all they had seen is the world go up and up and up, and they think everything's great. And now they're like, oh, wow, the world actually turns upside down and it gets ugly quick. I think it's been really interesting for them to learn and see, we've been saying to them, like, read everything you can. You're going to learn a ton. This is when your career can really change, because you learn things that you'll use in future deals to protect yourself, even though you think you don't need it. And then the world turns upside down again, and whatever you put in there worked. And so it's just more of an educational process that I think is a silver lining that we'll all use in the future.
That's all great. And for me personally at CB, we do a lot of industrial and cold storage. And so this has been a good environment for that. So we're thankful for that. And then at a personal level, I agree, we've traveled so much that I've had more dinners home in the last 3 months than I've had in the last 20 years. And it's nice to have more family time. And certainly appreciate our teams as well. I mean, these are trying times. And I think at all companies, teams have really come together and deserve a lot of recognition. And I think it really tests the value of teams. So we all have a lot to be thankful for. I want to thank you so much. We've got a couple questions. The first one was basically about whether lenders are more relationship or transactional focused right now, and whether they'd be willing to entertain new relationships. I know in our capacity, we're seeing definitely an orientation to take care of your existing customers. Not always, but it's less transactional right now, very focused on existing clients. But love to hear feedback for the audience from any of you.
We're definitely inclined to deal with our existing client base, right? And like everybody else, we're 30 years into this, right? And we have a lot of clients. But it's also the case that we believe, as I said earlier, that all of the assets are idiosyncratic, and it's across the board. And if you can't see it, feel it, touch it, right, I think it's very, very difficult to underwrite it. And so, like I said, we have 6 offices, but only 6 offices, not 600 offices. And so if we can't drive to it in this environment, or someone's not willing to get on a plane and go see it, which we've done now a couple times, we're not likely to make, we will not make a loan on an asset that we haven't seen. So that's the biggest hurdle. We can get to know a borrower, in a setting like this pretty well, and we can obviously do due diligence, and we can triangulate on that borrower for deals that they have done with other lenders in the past. All of us here are friendly competitors, so if I haven't done a deal with them, but maybe Peter or Abby has, we can all speak about it. We can get to know and understand the borrower, but their asset, that we got to see.
We had one other question, which was more about market share and who's winning more in terms of banks or debt funds. I think maybe the best way to phrase that might be, who do you see as your biggest competitors right now when you're out there competing on new deals, from a lender type? Who do you think you're seeing win most of the business? If anyone wants to step up.
It's these guys.
Everybody.
Our panel, right?
Yeah, it's other alternative lenders. But, and I'd say there are some, I think, more regional or nichier banks that are active too. I'd say the money center banks are the ones that really, I think, are not.
I totally agree. Yeah.
Up down.
And the agencies, right?
He shows up.
Yeah, we've been a little bit disappointed that we can't do some more stabilized multifamily because of how much the agencies have
The Fannie and Freddie are so strong right now on that, both in terms of pricing and proceeds. Yeah. Well, I think that's it. So we'll conclude our panel. Thank you very much.
Great. Thanks, Val.
Val.
Thank you. I think someone's going to come on from Samantha, maybe?
I'm here, Val. Val, thank you so much for a great panel, and to all the panelists as well for a great conversation today. We're very appreciative of that. That almost draws our event to an end today, but before we go, I'd like to thank our event sponsors one more time. Acorn Capital, Amherst Capital Management, Hall Structured Finance, Hodges Ward Elliott, Invesco Real Estate, Mac Real Estate Credit Strategies, Madison Realty Capital, Mesa West Capital, Pacific Western Bank, Parkview Financial, Sable Capital Partners, and Starwood Property Trust. Thank you all so much. And thank you again to all of our viewers for joining us today. Please stay tuned to future events for Commercial Observer. We have quite a few coming up, so just check the events tab on our website. Thank you again. Have a great day.